Significant portion of the household retail investor that is not engaged in the equity market. Despite the fact that we've had this trading speculation surge recently, most households are not adding to their equity exposure, sort of seeking that new risk addition to their portfolio. And until we get to that point, sentiment is going to remain somewhat supportive of the equity market advance.
Gina, thank you so much. I'm watching all the news flow here, folks, as we go to the equity markets this morning. Gina Martin-Adams, who I've never heard say go to cash with us today. She has participated like no one. We're beginning to see some movement in the VIX, 21.79 right now. You really wonder where that will be at 9:30 with this nice lift in the equity markets. He has always been a voice of optimism. On this jobs day with the policy wins that are out there, Mohammed El-Arian of the University of Cambridge, Gramercy Funds Management, and of course writing for Bloomberg. Stay with us. This is Bloomberg Jobs Day. Good morning.
We have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
All-nighter, that's what it was, up on the Hill. Something maybe new and different, lots of different votes. Greg Villiers writing up Jody Ernst of Iowa's effort to move the minimum wage aside. That succeeded. The minimum wage is not in the legislation for the Vice President of the United States. She does what Joe Biden did do as Vice President, and that is cast an important and deciding vote. Watching all this is Carl Riccadonna of Bloomberg Economics and our chief U.S. correspondent. Carl, has your team quantified what $1.X trillion would do to global GDP and what it would do to non-farm payrolls 6 months out?
Sure. We're looking for growth of about 3.5% this year, and that was assuming that we would not see stimulus 3.0 3.0. So if stimulus 3.0 passes in its original size, which was close to $1.9 trillion, we would be looking at moving that U.S. GDP forecast from about 3.5% up to something at near 5% or maybe a little bit more.
Carl, this is important. I put out on Twitter yesterday, the Telegraph in London had a headline talking about the gloom of negative interest rates, and next to it somebody was modeling 5% UK GDP. Why are we doing all this if our GDP statistic is so good?
Well, I think that central banks are prudent in evaluating downside risks to the economy and what tools would need to be employed if we did see a downside scenario, maybe due to variance or some other type of shock to the economy. However, an important lesson here that we can, we can observe it in theory. We can also observe it in practice. In the case of the European Central Bank, is the efficacy of negative interest rates. And U.S. policymaker time and time again has pointed to the European experience to say that negative rates were not an effective policy tool. In fact, they looked to be a mistake. Sweden reversed course on that front, and now Bank of England, unfortunately, is considering the reality of negative interest rate policy. The Fed is nowhere near that level. If you hamstring the banking sector, you shouldn't expect a healthy economic outcome as a result. We need credit extension in the economy to have healthy economic performance. So I hope that Bank of England doesn't get to the point where they go down this perilous path, but certainly the Federal Reserve is not even really viably considering it for its toolkit at the current time. We can see that QE is much more effective. So if you have another leg down in the economy and you need more stimulus, pull the QE lever, not the negative interest rate lever.
Carl, if we go back to the U.S. jobs data, who's actually hiring in the U.S. apart from Amazon for delivery drivers?
Well, we can actually see a pretty significant bifurcation in the employment numbers. And so that's why we somewhat glibly titled our preview, Set Your Decoder Ring to K, because it really is the K-shaped labor market recovery. We keep talking about a K-shaped economic recovery. It's true in the labor market as well. And just to put some numbers around that, if we look at the sectors that are doing well, like goods-producing industries, manufacturing, construction, or even service sector industries that are resilient, like finance and real estate, and a whole host of other categories. That section of the economy added about 470,000 jobs last month alone. But on the flip side of that, the downward leg of the K, we can see as hemorrhaging jobs. They lost over 600,000 jobs last month, and that's things like leisure and hospitality, department stores, kind of the obvious categories. And Jay Powell talked about this in his press conference when he highlighted that the pockets of weakness in the economy. And to be sure, as a macroeconomist, you're much more happy to see pockets of weakness than a broad-based malaise. And so as we look at today's jobs report, understanding the divergence in those two arms of the K is going to be much more important than the headline number.
So, Carl, what you're telling me is that the U.S. is actually creating somewhat quality jobs. What does the Biden administration do? So there's a clear pivot to green. Does that create quality jobs that Americans want?
Well, I think, a pivot to green would create a lot of construction jobs that tend to be union jobs, or at least higher pay with better benefits, a lot of engineering jobs and development jobs on that front. So I do think a version of a Green New Deal, or at least an infrastructure deal, even more importantly, would create substantial jobs. As we look at these job numbers, it's very confusing because we had a massive hiring surge in the back half of last year. What we have to remind ourselves as we think about that slack in the economy that Tom highlighted, that Janet Yellen was discussing, we are still about 10 million jobs in the hole compared to where we were in February of last year. The real unemployment rate, therefore, would be closer to 9.5%. So we shouldn't be talking about a run-hot economy or hyperinflation or even a significant pickup inflation when the unemployment rate is at 9.5%.
Now, Carl Riccadonna there with First Principles, folks. That's what we love there, where you get right back to what is that employment gap. We had Jared Bernstein on yesterday from the Biden administration. Of course, it's Center on Budget and Policy. He's been talking that kind of perspective for years of a real unemployment rate higher higher than where we are statistically. Carl Riccadonna leading our economics coverage at Bloomberg. Futures up 20, Dow futures up 152. On this jobs day, what do we see in the markets? Well, you see the financial lift in equities, and you see it in oil as well. West Texas 56.78, Brent crude 59.47 as well. Not much story in dollar today. I do want to say that euro set at 119.80. They're below the 120 level. Weaker dollar, I'll say, through the week. Where are we focused? Well, we're focused on the economics of this nation. Wonderful guests coming on to give us perspective as well across our simulcast. Looking forward to that. Heather Boucher joins in the 9 o'clock hour as well with the President's Council of Economic Advisors. Please stay with us. This Jobs Day, this is Bloomberg. Good morning.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Vaccination and normalization strategies.
Maybe the optimism is going a little bit too fast.
The market's going to struggle at some point this year.
There are a lot of people who can't go back to work.
There is still a lot of scope for scarring in the labor market.
The virus dictated the downturn, and it will dictate the pace and the shape of the recovery as well.
It's clear that the destination for this year
is COVID off?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Equity futures up 20 points on the S&P 500, all-time highs this Friday morning. Tom Keene, Payrolls Friday, just around the corner.
Payrolls Friday here at 8:30. We've got lots of good conversation on that, John. But what it was the all-nighter we saw in the Senate as they drive to stimulus. You mentioned Lawrence Summers in the Washington Post doing a compare and contrast of this stimulus versus where we were 10 years ago. It is an opinionated Lawrence Summers pushing against his team.
That article dropped in my inbox from Bloomberg's Michael McKee first thing this morning, Tom, and it's a clinical teardown of the size of this package. He compares and contrasts the size of the output gap in 09 to the size of the output gap that they expect to see in the coming months, Tom, and then looks at the relative stimulus programs relative to that output gap and basically says, Tom, and my words, not his, this is huge. It's really big. What are the risks around it? And point by point goes through it. And I think the big point, Tom, where's the space going to be if this gets pushed through to do the infrastructure spending, the public investment spending that we need to see? Because this plan, doesn't address that yet.
He puts a three-factor on it as well, John, and where you bring that over into the markets like what you and Lisa follow. John, look, folks, for the real yield this afternoon.
Thank you, Tom.
Very important there is the vector of inflation expectations, and that's been the story of 2021. That line hasn't given up. It points to what Summers is looking at, higher inflation.
The story of the week, though, Tom, you've been on top of it. Yields up, curve steeper. See that again this morning, up a basis point to almost 116 on a US 10-year. Your estimate, 105. And Tom, as you pointed out through the week, that estimate has just ticked a little bit higher over the last couple of days.
Non-farm payrolls looking better. Mike McKee will dig into all that as well. I thought Rick Adana was great going back to first principles as 9 gazillion, 10 gazillion unemployed. And the fact of the matter is, what is the real unemployment rate in this nation?
We'll talk to the economists over the next 90 minutes as we count you down to that payrolls report. That spread is wide, wide, wide. Top end, plus 400,000. Bottom end, negative 250K. Lisa Abramowitz is 90 minutes away.
Yeah, the 8:30 a.m. jobs report. I'm trying to understand what exactly the market response will be to a surprise to the up or a surprise to the down. You could see that we've seen an incredible amount of progress over the past couple of months. It stalled out in December when we did see a drop off. Now, if we get a better than expected jobs number, does that mean less emphasis on stimulus in Washington? If we get a worse than expected, does it mean that momentum isn't necessarily getting up to speed? Is good news at this point good news, John? 9:45 a.m. to build on what you were talking about, this question about stimulus. President Biden, Vice President Kamala Harris are meeting with House Democratic leaders. This follows the vote last night in Senate. It is clear that the Democrats want to go it alone. And really, John, I think you honed in on the key question here. How much air does this take out of the room to do anything later on in the year, given the fact that Republicans are not on board with this? This is not a bipartisan Washington right now. Also today, FanDuel and DraftKings CEOs Matt King and Jason Robbins are joining Bloomberg Television. It is before the Super Bowl. And the reason why I am particularly interested to hear what they have to say is how much, yeah, I know, I knew you were going to ask me about this, is how much are people returning to sports betting? People have been talking about Robinhood having to do with people not having anything to do or bet on.
The Brady video.
And honestly, that is a question. You know, how much have people abandoned sports betting? How much are they coming back?
Next 3 hours.
How much interest? I want to just see John's face just rolling his eyes at me. I can just imagine.
I'm okay.
Are you?
Can we get some Brady video now to keep her happy?
I think that's probably all. Maybe that's why she actually did this, Tom.
You think so?
Got nothing to do with DraftKings. Has Lisa Abramowitz ever mentioned DraftKings on this program?
Guys, can I get some Brady on radio? Brady video looks
it works
good
really
morning,
well,
106. Good morning, 106.1 in Boston. Great 106.7 in Boston. Greatly appreciate you supporting Lisa in her Brady-thon today.
That's the extent of the Super Bowl coverage for the next couple of hours, unfortunately. Let's get to the price section quickly. Equities, Tom. All-time highs, record highs on the S&P 500. I caught up with Chris Harvey of Wells Fargo in the last 24 hours. He's at 3850 year-end. Cities, Tobias Lefkovich, 3800 year-end. Tom, 3883 is where we sit this morning on February 5th.
John, I put the Ibbotson chart together here, going back to the Guadalcanal 1942 lows. We're not going to show it right now on radio and TV, but John, the people betting against this market, the people betting against American stock market capitalism and prosperity, the word from President Obama years ago, they've been shellacked.
Oh, Tom, totally. And I would go one step further. If you were short the market last year, technically, you were short ingenuity. You were short the healthcare community, and they managed to pull something massive off. And that vaccine news of the last 4 months, Tom, that's been a story.
John knows the manse I live in. It's a 6th-floor walk-up. And, John, I walked into the lobby today, and I kid you not, yesterday, rather, there were 300 boxes from Amazon.
From Amazon.
300. I'm not exaggerating. And they're getting littler. They're getting they're ordering, they're ordering bow ties.
Is that what they're doing?
I got a
little bit of space here.
I got Kennel Fee, the Tiffany collar last night. He came in a little, box.
Anything to say on a particular football game that happened yesterday before we move on?
I'm in trouble. I left Banters. I was like Schumer down at the Senate. I left Banters in Brooklyn at like 4 a.m. to get to the show on time.
Okay.
In Brooklyn.
It's heartbreaking.
Tom down in Brooklyn.
It's like they're done, right? Kane lost, and they're done.
I mean, they're out of the title race, that's for sure.
Thank you.
That's the extent of the football coverage this morning as well. Priya Misra standing by.
Soon, though, the Brady coverage.
Priya, great to catch up. I mean, Lisa can't help herself. TD Securities Global Head of Rate Strategy joins us now. Priya, Lisa asked, I think, probably the most important question ahead of this payrolls report, for this market at least. It's not about the number, it's about how the market reacts to that number. Can you walk me through what you expect in about 90 minutes?
So we are looking for a much better number, but largely due to seasonal issues. I mean, there has been better economic data, I'd say, over the last month, actually much higher compared to what you would have thought given the COVID surge. I think it's the pace of vaccination rollout, the fiscal stimulus, all of that has helped. We are looking for a better number, but I have to say, as a rate strategist, it's hard for me to say I don't think payrolls really matter. I don't expect a very big reaction, even to our 400K estimate for today, largely because it's all about the future. It's all about the pace of vaccinations. It's about this fiscal stimulus package. I don't think more than $1 trillion is priced in. So if it does look like the Senate is going alone or the Democrats are going alone, I think we're looking at 1.7 trillion. I don't think that's priced into nominal rates. It's not priced into real rates.
Priya, the money question this weekend, I think of all the people, they open their barons up on the dining room table, as my mother used to do, is what is the 10-year yield that's critical? If we're in a range-bound 10-year yield, we're up at the top of the 10-year yield, 1.1566. Where is Priya Misra's trip point where you see escape velocity to a higher 10-year yield?
So I would say it's real rates that really matter. 10-year real rates are at minus.
On a real yield, I get it.
So I think, if that minus 1% 10-year real rates go to minus 60 basis points, so 40 basis point backup, I think that's the problem. That's the problem for the dollar. The dollar strengthens a lot more. I think risk assets take note. I think the Fed takes note. At 115 on the 10-year or 130, which is our target, I don't think you're at a level where it's going to impact the economy. Mortgage rates have barely risen. So your escape velocity is actually much higher. And if we're seeing a 1.9 trillion stimulus package, I think the market's going to push rates until the natural circuit breaker, I think, will come from real rates. And we're very far from that circuit breaker right now.
Priya, John and Tom were talking about if you'd been short this market heading into this year or heading into last year, you would have been short ingenuity. You would have been short the ability to overcome the pandemic. Is that an accurate way of looking at it, or would that be being short the Fed, being short stimulus payments, and being short the actual things that are propping up the market in addition to earnings recovery?
Right. I think the Fed is a big part of that. I was going to say, when I heard you all talk about ingenuity, it's also the Fed resolve to keep real rates here. I mean, we're here in real rates because they've told us it's too early to talk about tapering. It's certainly too early to talk about hikes. If the Fed is not hiking until 2025, how high can real rates go if they continue to buy QE? So I think if that 1.9 gets passed, it's going to, we're all going to then focus on the Fed. Are they going to buy more more treasuries? Are they going to extend weighted average maturity? If not, then the rates market, it might stop in terms of how much risk assets can go up.
Priya, I love the way you talk about the real yield circuit breaker. Folks, here the real yield circuit breaker. Should Faro do 30 minutes or 60 minutes this afternoon on the real yield? Priya, I want to talk about the negative rate movement I observed this week in Europe, where there is a smaller negative interest rate. What does that signal?
Well, I think there was a lot of focus on whether the Bank of England was going to go into negative territory. The Fed has been very clear that they're not going into negative anytime soon. I think the ECB has gone negative. And while I think Bailey didn't really take it off the table, it's not likely. And so, which is why I think we've seen, global markets rise. I would say the US move is much more stimulus, but certainly for bonds and gilts, they were completely not moving because of this fear of negative rates. And, when you start going into negative, there's sort of an infinite amount that a central bank can take rates negative. So by not taking that step, they've actually sort of said we're going to be at the effective lower bound. I think it's reducing the amount that the market can price in further easing from the Bank of England as well as the ECB. So I think that's the move. But I would watch global rates, actually. If we do start to head higher, that's going to propel this global rate sell-off much more than just what the US can do alone.
I have to admit, I'm so confused by the Bank of England right now. Priya, great to catch up. Priya Misra, TD Securities Global Head of Rate Strategy. Tom Keene, have you seen the banks this week? JP Morgan's up 7.5% over the last few days.
Yeah.
Unreal, up 7.5% on the week so far.
Yep.
The banks, the KBW Bank Index, well-followed bank index here in the United States, up almost 9% on the week, Tom. Unreal.
Did we see a bad earnings view from, a major visible company? I don't think so. We've seen some that were a little moldy, a little soggy and all that. But, John, I mean, their earnings have been good, and then you've got this interest rate shift. And, folks, this is a first principle. I know you don't hear it from business TV. Stocks matter, but what really matters is the land of Abramowitz and Farrow, which is fixed income. And fixed income, John, is talking.
Yeah, the rates move, the bond market, the spread between 5s, 30s. Pick your spread on the yield curve, Lisa. That's at the epicenter of this bank's move this week.
Yeah, and there's a question of how much this has to do with supply, how much this has to do with growth, and whether people perhaps have gotten a little ahead of themselves. I'm sorry, I have to just throw that in there, John.
Okay. Don't think I didn't notice that you used the guest to cut me down.
I wasn't cutting you down. I think it's worth
just so
it to
you know, it's noted from New York City for our audience worldwide, alongside Lisa Abramus and Tom Keene. I'm Jonathan Farrow. Futures up 18. Lisa's always right. The S&P 500 up 0.5%.
British sarcasm.
Payroll's just around the corner. No, you are. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. A 15-hour session in the Senate ended with lawmakers adopting a budget blueprint for President Biden's $1.9 trillion stimulus plan. The vote was 51-50, with Vice President Kamala Harris breaking her first tie. The House will likely vote Friday to adopt the Senate's language that would allow Democrats to approve the stimulus without Republican support. The House has voted to strip Georgia Republican Marjorie Taylor Greene of her 2 committee seats. That's for embracing conspiracy theories and violence against Democrats. 11 Republicans voted with the Democratic majority. Earlier, Greene said she disavowed her previous views. The UK will require travellers from coronavirus hotspots to quarantine starting February the 15th. Arrivals from countries on the UK travel ban list will have to isolate for 10 days in government-approved accommodation. Authorities are seeking bids from hotels near airports and ports. Meanwhile, Sunday's Super Bowl in Tampa presents an experiment in coronavirus immunity. The National Football League is hoping to avoid any large-scale outbreaks at the game. Overall attendance has been capped at 25,000, a record low for football's biggest event. The league has given a ticket to 7,500 vaccinated healthcare workers. And it's the biggest internet IPO since Uber went public back in 2019. Shares of Kaisho Technologies rose 161% in their Hong Kong debut. The company operates one of China's most popular short video services. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We'll confront China's economic abuses, counter its aggressive, coercive action to push back on China's attack on human rights, intellectual property, and global governance. But we are ready to work with Beijing when it's in America's interest to do so.
In some very specific ways, the new government sounds a little bit like the old government. President Biden there on China, the threat of China and working with
I'll go there,
China
John.
as well.
Yeah, I'll go there.
Very similar, Tom. There are subtle differences, but it's very similar, and I'm not sure it's going to change too much in the coming weeks and months.
And I mentioned this earlier with Martin Schenker, the idea that the NSC is looking at Iran maybe shows, again, that polarity that we expect, Trump, Biden, versus sort of on the same page on China. They are not on the same page. It is on Washington. Cirilli pulling an all-nighter with the Senate. Kevin Cirilli, our chief Washington correspondent. Book, he was not going to be on today, folks, but we need to be balanced at surveillance, on radio, on TV. So as we have a Brady love, we've got to have a Brady hate. Kevin, for our global audience, explain the hatred for Tom Brady.
Well, hate's a strong word, Tom. I'm not a hater by any stretch of the imagination, but hardly will I be rooting for Tom Brady, who, of course, has a long history of controversy that dates back to Deflategate in New England. And look, I mean, I was disappointed when Andy Reid left the Philadelphia Eagles, but look, once a Philadelphian, always a Philadelphian, and I'm going to be rooting for Coach Reid this weekend.
Kevin, we use the word hate because it fit the banner. Let's keep moving. Kevin, I look at where we are right now, and let's talk about the hatred that's out there in Washington. How is the center framing up in Washington? John mentions China. Yeah. How is the center done? What are the optics in the last 48 hours?
You know, I was struck by a letter that President Biden's U.S. Trade Representative nominee, Katherine Tai, sent to members of the Senate and the Republican Party just this week. And they asked her specifically about whether or not she would remove Huawei from a list of restrictions once she's sworn in. She is enjoying bipartisan support, will likely get bipartisan support for her confirmation. And she said point blank in her response to the letter that she doesn't see the need to immediately remove companies like Huawei and ZTE from these lists that the Trump administration had put in there. And I bring this up because in speaking with a source yesterday close to the U.S. Trade Representative nominee, there is, as Jonathan pointed out, a center in Washington, D.C. that is very much speaking from the same geopolitical playbook in terms of how to deal with China. And that center policy we've seen really emerge over the past 6 months, I would say.
Let's pick up on the buzzword of the last couple of weeks, Kevin, bipartisan. Where's the bipartisan effort on the fiscal side now in Washington?
Well, where there might be bipartisanship with U.S. and China relations, there is no bipartisanship with the $1.9 trillion worth of stimulus, and this is falling into the ideological camps. Yesterday, I interviewed Senator Marsha Blackburn, a Republican from Tennessee. She has deep concerns about whether or not the United States can afford to take on $1.9 trillion worth of stimulus. But the bottom line here is that for Republicans who might be more in the middle and willing to have more economic stimulus within the next 6 weeks, that is actually an easier vote for them, Jonathan, than voting to convict former President Trump in the trial next week.
And John and Lisa, I know, Lisa, you want to pick it up here. What I find amazing here is you've got Marsha Blackburn on the same page as Lawrence Summer in the Washington Post. I find that remarkable.
Yeah, the idea of what is the correct size in order to actually solve the immediate problems versus actually stimulate the economy. Although, Kevin, this does go exactly to the heart of the question I wanted to ask you. If the Democrats go it alone, does that take any additional stimulus, true stimulus, infrastructure spending, et cetera, off the table for later in the year because they will not be able to get that bipartisan support?
Yes, in the sense if they have to get through, if they need any Republican support from a procedural standpoint in order to bring a budget measure to a vote because of the narrow majorities that they have in the House and in the Senate. If that's too wonky, I would also note that if President Biden does not get the $1.9 trillion stimulus through in his first 100 days of office, Lisa, then he would be missing out on a significant domestic accomplishment in his first 100 days, juxtaposed with the rollout that they're pushing for on the vaccination effort. When Treasury Secretary Janet Yellen is speaking on Good Morning America, as she did yesterday, and continuing to drum up support for $1,400 stimulus checks, something that President Biden has really said has to be included in these negotiations, it's just another illustration of how Democrats right now feel that they've got to take this case, not even necessarily to people like Senator Mitt Romney, who offered up a trial balloon of a compromise yesterday, but Senator Joe Manchin, because those are the types of centrist Democrats who are still in some ways on the fence about whether or not the country can afford so quick to make another down payment on recovery.
Kevin, the size of the check is only one part of the problem. I'd argue it's the smaller part of the problem. The bigger problem is eligibility for those checks and whether this administration can reconcile its differences within the administration, within their own party, on who should be eligible and who should not be. Where are we now?
You know, that's the underreported story through all of these negotiations. And I'll be frank here, Jonathan. I spoke with a source within the last week who is very plugged in to the liberal democratic socialist wing of the party. And this source was incredibly frustrated about the dynamics of a stimulus package that they feel and their camp feels has not gone far enough. And so that tension bubbling over, while they are willing to give President Biden and stick with him on a significant victory in his first 100 days, longer term is going to be a story to watch.
Kevin, thank you. Kevin Cirilli, down in Washington, D.C., and of course the host of Sound On Bloomberg Radio. He's warming up. He's been away a while.
Warming up, you know, Monday.
I've got experience. You know, you take a bit of time off, you come back.
Oh, really? You do have experience
about being berated by the team for the sabbatical.
People don't get nervous on this. Kevin,
I can't feel my face. I'm prepping for the weekend halftime show this weekend.
I wish we had a microphone and a camera for the commercial break about 5 minutes ago. Kevin, they would have loved it.
We're saving everybody.
When Tom Keane found out the weekend,
I had no idea. He's great. I love it.
What do you love about him, Tom?
The mixing, the engineering. You know what I love about the guy?
Please.
His team effort. You can tell he goes into the studio and there's no egos, no nothing. It's him and 10 people putting it together.
Just like surveillance.
Serbankanay and mixing. It's just
like surveillance. The mixing's amazing.
This is like surveillance. Can I say something? This? Can we get back on script?
Let's talk
Steve
about stimulus.
Ratner killing it over with Joe and Mika on John. If you make more money, you don't spend the stimulus check. You save it.
Yeah.
And it's like this. It's like Marshallian Ratner killing that idea.
Well, Mr. Ratner is correct. That's the issue. Relief or stimulus? If it's stimulus, what are you stimulating in an economy that is still shut down, Tom? Where does the money go?
GameStop. I don't know.
Goes into savings.
Well, actually,
when's Tom ever said, let's get back on script? When did this start?
This is fantastic. I will just keep on script for a second with Jared Bernstein. I think he said something really interesting, the idea that people are saving money to pay down debt that was deferred. And that is an idea that really has not been discussed as much as others, Sean.
Good point, Lisa.
Thank you.
Just as always.
Do you think he's going to open with blinding lights?
I can't handle the
sarcasm.
sarcasm.
He's got to open with blinding lights. I mean, you know, it's got an upfeel.
We should have got that tune.
It's got to be better than Justin Timberlake.
To the weekend.
Payrolls Friday. 1 hour, 5 minutes away. Full of jokes on this program, aren't we?
I've been trying.
From New York City, this is Bloomberg Surveillance on this Payrolls Friday. That number comes in about 1 hour's time. Your estimate is 105,000, and that estimate has been ticking higher as the week has progressed. As this week has grown older, we've added more and more weight to the S&P 500. all-time highs on the S&P, 4 straight days of gains. Can we make it 5? We're up about 0.5% on the S&P 500 this morning, up 19 points, underperforming relatively speaking just a little bit. The Nasdaq this morning up about a third. The Russell, the small caps, back on top. Switch up the board. It's been a story of the bond market at the epicenter of everything. It's always rates. It's always in fixed income. In your bond market, no bias. Your 2-year yield pinned to the floor. One of the most important headlines I've heard from a central bank in the last 12 months or so actually came from Australia in the last 24 hours. Governor Lowe, Tom Keane, wait for this. Governor Lowe of the RBA basically saying rates aren't going to rise until 2024.
Yeah.
Get your head around
it's
that.
It's a calendar derby, but he's got to deal with
now.
a huge weight on China.
That's the guidance now, 2024. Who's in line with them? I would argue the Fed, maybe the ECB. This is nice, isn't it, this interaction?
Seriously?
I thought you were in Key West. I didn't know you were here.
No, I'm back.
Oh, okay, great.
Bond market then. Yield curve, steeper, yields higher, up a couple of basis points and 10s and 30s again this morning. And I think Lisa's right. How this bond market responds to the jobs number in about 60 minutes, I think is the big unknown. How does it respond? Downside surprise? Do you start to factor in more stimulus?
What else do you have?
Let me get there, Tom.
Seriously?
Let me finish the thought. You okay?
Okay. I'm
just
looking
itching
at
for
oil.
Sunday.
I'm excited about oil.
What's wrong? Calm down. It's all right. Let me get to the banks. Just going to talk people through the yield curve.
Okay.
And finish on this. Then I'm getting to Remain. You'll get your chance, Tom. You'll be back in the spotlight shortly. Okay. I know it bugs you. Deep breath.
Oil.
Have a drink. Yield curve, steeper. Finish on this. The banks. Huge weekly rally for the banks. Just massive. KBW Banks Index over the last 5 days looks a little something like this. Up around about 9 percentage points. Unreal. All of that off the back of a steeper yield curve. Remain Bostic. Good luck. Run me through the stocks.
Do they keep Tom sealed in that cage to protect him
reason,
from you,
Remain.
or to protect?
We haven't figured that out quite yet.
All right. Well, let's look here. I mean, you were talking about the banks here. I mean, look, there's a big sort of reopening trade taking place here. We have Gilead Sciences. They actually reported earnings after the bell yesterday. A lot of people were, of course, looking for that revenue growth out of remdesivir, of course, that COVID-19 treatment. The revenue growth was there. They're expecting revenue there of about $3 billion this year. But more importantly, the rest of their business is also doing well as well. Of course, most of their revenue comes from that HIV/AIDS franchise. They are expecting that to get back on track. CureVac was just crossing the wire a little bit while ago. They're in a pact with the UK to start producing doses of their vaccine. Still waiting for final approval, but that should come down the pipe within the next couple of months. And then Cardinal Health also out with earnings. And interesting, they talked. This is a big, of course, medical distributor.
What'd they say?
Hospitals, they're saying they're seeing much more pickup in demand from hospitals. That's a good sign because they're saying a lot of the stuff that they ship is for non-COVID related stuff. So you go back to the hospital for your normal treatments, your Botox, whatever you want there. Cardinal Health making a lot of money there. Flip up the board here, and we could also take a look at some of the other names here, also benefiting here from this retail trade. On a weekly basis, you're seeing a lot of the retailers rise higher. You're seeing names like Expedia, travel companies, up 14%, Live Nation up 14%, Carnival Corp up about 12% on a weekly basis up here in the pre-market here. Key Corp, you talk about the banks, John. They've been, of course, not only benefiting from this increase that we've been seeing in yields, but we've been seeing a lot of bullish commentary out of the street here about just sort of the general pickup in demand out there, the economic demand, and how that benefits the banks, particularly the small and mid-cap banks. That's where a lot of analysts are saying you should turn your attention to. They're much more strongly correlated with that yield curve, and right now they could be the beneficiary. Tom?
Romain, very quickly here, have you researched Chevron, Noble, Midstream? I don't want to be unfair. There's a huge news flow, but any thoughts on that?
I actually did not this morning, but okay. I did research Pinterest. I was checking out the Bloomberg Surveillance Pinterest page a little bit earlier this morning. They reported earnings, and they're doing well, Tom. Up more than 70%.
They are as well. But, I think, John, to get back to the data check, and I think it's important here, the basic idea of Brent crude at $60 a barrel is being way underreported.
Energy's doing nicely.
It's a huge deal.
I agree with you. Romain, thank you. Thank you very much. I appreciate you, Romain. I really do.
I do.
Romain,
I
thank
do
you.
too.
Thank you.
I mean, thank you for the Botox shout out.
It's serious there about Cardinal Health. I mean, it's really important. They're massive in distribution.
2 to 5 Eastern on the close with
Watch us from 2 to 5 this afternoon. They don't keep us sealed. We actually are all together.
Because you like each other, Romain. Yeah. That's why.
Okay, on the jobs report, we start with Ellen Zentner of Morgan Stanley, their chief U.S. economist. She's been extremely good about the agony of getting from February to February and joins us this morning. Ellen Zentner, is the good news we believe we're seeing off the horrific news of 30 days ago, is it a one-off or is there a trend in place?
No, so I don't think this is a one-off. Now, I don't think the positive job growth that we expect to be reported later this morning to be the start of that massive inflow back into the labor market as we saw last year as we were coming out of lockdown. But it is going to have the feel of maybe we have turned the corner in that we saw restrictions were being still put in place through about mid-December. And then from mid-December onward, we didn't have any further restrictions. And now we started to just see some of those restrictions come off. And so that should allow more workers to return to restaurants, but it's going to start like a trickle, and then it will start to roll more quickly as we head toward the spring, especially as we get into March.
Ellen, how much stimulus do we actually need? How much fiscal support in order to really get this labor economy accelerating in the way you would like to see?
Well, I think the issue here for Congress as they contemplate this next stimulus package is that the longer they delay or the longer it takes to get a package passed, the more we're going to be in the midst of a big pickup in economic momentum. And of course, there's nothing like economic momentum to push Congress off of passing a needed package. I think what I can see is that the Democrats would really like to be able to provide further rebate checks, extend those federal supplemental unemployment benefits because those benefits expire in March. And so that's why I think there's a great impulse for them to get something done in March. And that's when we expect about $1 trillion package to come. But there is a very real risk that it just doesn't happen. I think that we can survive it. This is something that I talked about late last year. It's nice to build that bridge all the way into the middle of the year when the unemployment rate has been coming down more significantly. But it's not going to be end of days if we're not able to get another package.
It's not just the headline number, Ellen. It's also the composition. What programs are actually being provided for? From your economics hat, what are the most effective programs the U.S. should be financing right now to get employment back up to speed?
So right now, you want to provide support, especially for those that are unemployed, because you don't want them to detach from the labor market altogether, because then there's a high probability that they just leave the labor market and don't ever come back. Then you get that longer term structural unemployment, which really depresses growth over the long run. And so in order to keep those folks attached to the labor market until they can get employed, it's good to have those unemployment benefits and other income assistance, forbearance programs and the like that are really geared toward the lowest income in this case, because it's those service sector, low wage paying jobs that have seen the most job loss. And so that's why lowering that qualifying income bracket for those rebate checks, as we did with the $900 billion stimulus in December, that's really the most effective. And we can see that they are spending those checks. I think that package could not have come at a better time. We were on track to see very low to possibly negative GDP in the first quarter, but we can see in January a real pop in spending among the lower income households as those checks came in.
Can you walk us through where you think the savings rate is going to be heading through the rest of this year, Ellen?
So I think with another $1 trillion package in the first toward the end of the first quarter, we're not only going to see the pop in the savings rate from the checks that went out starting at the end of last year and into January, but we're going to see a further rise in the savings rate in the second quarter if we do get that next package. Thereafter, it's going to really drop hard in the third quarter because you don't have government transfers coming in, but you've got labor income coming in. And so it's going to be a big volatility in the savings rate as we saw last year. But ultimately, we think it takes over the course all the way through 2022 to come down to levels that we had pre-COVID. Most likely lower than levels we had pre-COVID, but I think that where we come to rest could be around pre-COVID or higher, so around 8.5% unemployment rate. What we have, though, is a very big cushion that's been building in excess savings. As you know, this is something we've been writing about since early on last year when we went into lockdown. That cushion is very important because it can help fuel buying power of households for longer. They may not spend all of the income they're getting today, but that cushion is there to support spending all throughout the year.
But Ellen, your claim was based off acute analysis of the consumer and the deciles of the consumer. Okay, I'll take it. There's a savings cushion, but isn't it the upper, quintile that has that savings cushion? Are you telling me half of America in the bottom has a savings cushion?
Yes, I am. And now you're right on the wealthy. Not only does the top income quintile represent just about 40% of all consumer spending, they are also the savers. If you think about it by income group, let's say income quintiles, 30% savings rate for the upper income quintile and minus 130% for the lowest income quintile because they spend more than they get because of those government transfers. This is unique, Tom. When we went into lockdown last year, we sent out checks to everyone when they couldn't spend it. And so likewise, this time, we're going to see caution. We're going to see that they're not able to spend all of it. Now, they save more than 50% of it. And savings means putting it under your mattress, putting it in the bank, paying down debt. But some of that will trickle into the economy, and we do have savings, and we can see savings that are, again, being built up across all income groups. So it's unlike any other time that we've seen. The lower income groups don't save. But here's something that economists have to consider. Because the lower income groups are not your savers, their propensity to consume out of that savings is quite strong. And so this goes back to Lisa's point of what's the most stimulative. You target those lower income groups.
Ellen, always great to catch up, especially on Payrolls Friday. Thank you. Ellen Zentner there, Morgan Stanley chief U.S. economist. Really important headline came yesterday evening from Johnson & Johnson that we haven't discussed yet, so let's do that quickly. J&J applying for emergency youth authorization, Tom, for their one-shot vaccine regime. Could be a game changer.
The one-shot thing, I'll go with that, but mostly it's just day after day after day getting it done.
After you interrupted me a little bit earlier, a little bit of payback. Coming up in about 50 minutes' time, the payrolls report. Then at 9 a.m. Eastern, on the Open, your lineup. Mohammed Al-Arian from Queen's College, Heather Boucher from the Council of Economic Advisors, Anastasia Amoroso from JP Morgan, and Rick Reeder of BlackRock. And just maybe, maybe, the weekend together with Mike Collins of PGIM. That'll be fun.
I look around and surveillance is cold and empty. Oh.
Do you like that?
No one's around to judge me.
We sit on that promo.
I can't see clearly when
it's all coming up. 1 hour and 20 minutes time.
Sounds like keep singing.
That was my favourite. I really don't want to go.
With the First Word News, I'm Rishika Gupta. The Senate has cleared the way for Democrats to pass President Biden's $1.9 trillion stimulus plan without Republican support, if they want to. After 15 hours of considering amendments, the Senate voted early today to adopt a budget blueprint for the Biden plan. The vote was 51-50, with Vice President Kamala Harris breaking her first tie. The House will likely vote today to approve the Senate's language. And Treasury Secretary Janet Yellen found that the stock and commodity markets remained resilient during the recent trading volatility. That's after she met with the government's financial regulators. She called the meeting after surges in stocks such as GameStop and sudden trading curbs on smaller retail investors. And German Chancellor Angela Merkel warns that it's still too early to ease the lockdown in Europe's biggest economy. The pandemic is starting to show signs of slowing down. Still, Merkel says she wants the economy to open without having to close it again too soon. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Ultra easy financing conditions for a long period of time, it can create incentives to reach for yield. It can cause some to misprice risk in markets. The real priority right now has, again, been addressing this extraordinary shock. And the Federal Reserve right now is far away from what I would say is achieving its objectives.
What's interesting about those comments is the first comment described the policy of the Federal Reserve over the last 12 months. That was Esther George of the Kansas City Fed, the president, weighing in on the situation right now. From New York City this morning, good morning. It is Payrolls Friday. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro, and we have equity markets at all-time highs. Here's your S&P 500. We had 18 to the S&P, up around about 0.5%, approaching 3,900. Tom, you joked the other day, are we on 4,000 watch?
Yeah.
Maybe in a couple of days. In the bond market, yields up 3 basis points, curve steeper, 1.1652% on a US 10-year. And the euro with a little bit of a bounce back. Rough time for Europe over the last few months. Euro dollar 119.88. Tom Keene, that currency pair up about 0.2%.
Yeah, but John, look at the 10-year yield, 1.17%.
I'm with you.
Folks, radio and TV, I mean, this is, I'm going to start, it's a jump condition.
We're creeping higher. The curve is steeper, and I think Lisa asked the most important question going into payrolls.
Yeah.
How does that bond market, the one thing that I go to immediately, what does the bond market look like after payrolls? How does it respond to a downside surprise, an upside surprise? I'm not convinced either way at this point, Tom.
Yeah, well, what we're going to do right now is continue this dialogue on emerging markets, the effect of what we see in the United States, this recovery, and what it means. And, of course, that means we go to Damian Sassower. But this is a real treat because, seriously, folks, Mr. Sassower of Bloomberg Intelligence is more than proficient at the gaming of sports. Damian, do you sense a really acute interest in the Super Bowl, or is it pandemic affected?
Well, I think, with all this focus on GameStop and Reddit and Wall Street bets, what people are really missing is the fact that if you look at Vegas sports lines at the sports books, I mean, it's a 3-point spread between Kansas City and Tampa Bay, not 3.5, even though 92% of the bets have been placed in favor of Kansas City. So where is the 3.5 points, Paul? I mean, Tom, I need 3.5 points to feel comfortable betting on terrific Tom in the Super Bowl.
When you see a 92% tilt, is it like investment where you go the other way?
Well, I mean, if you're a contrarian, for sure, but
I'm asking you.
Darian on you and pretend like I know things where I really don't. Where I'm really, focused is emerging markets, right? So even though I like Tom and Ben, it's about EM credit for me and the fact that we're seeing my universe move further down the credit spectrum. To reiterate the lovely Lisa Abramowitz, what is going on in high yield here? I mean, it's where people are going to get spread protection from rising U.S. yields. I mean, go figure.
David, I love you. You're great. You're saying, okay, well, we're going to talk about the Super Bowl, but I focus on emerging markets, so let's get there. There's been a lot of energy put into EM credit, and people have been saying it's going to be on the heels of a weaker dollar, an ongoing weakening dollar, which has been the consensus trade, and it has been wrong so far this year. Do you think things have gotten a little toppy in some of the most popular emerging markets you cover?
Absolutely. And you see the evidence just in terms of sector outperformance. It's been driven by energy and basics, those kind of, those sectors which give you greater spread protection from rising U.S. yields, at least on the dollar credit side. And so, I'm dubious here. I have to be honest with you. If you're looking for equity markets to test 4,000, and, as Gina Martin Adams, my colleague, points out, it's going to be upward earnings estimate revisions that are going to drive you there, i.e. fundamentals. I'm dubious on that. I think in a world flush with liquidity, we've gotten a little bit ahead of ourselves. But remember, in emerging markets, we always go to extremes. We overperform to the upside, we underperform to the downside, and we're still playing a bit of catch up here. So there's some more juice left in the tank.
Let's sit on that US dollar just quickly, Damien, because Steve Englander of Standard Chartered just published, and this is what he had to say, just briefly. We see these gains as temporary. This is talking about the US dollar. The vaccine gap between the US and the Eurozone may be well priced in. Damien, that's the story right now. It's the vaccine gap, the perceived growth differentials that are going to come down the line off the back of that. Do you think that is priced?
Wow, it's amazing that we're talking about currency movements and trying to correlate that to vaccine take-up. I am not going to predict where the markets are headed next. I have no idea where the dollar is headed next. But if you just want to look at street consensus, you're absolutely right. People are expecting the dollar to start depreciating again, specifically against the Asian currencies. And so that's where I'd probably dig my heels in, Jonathan.
Damien, help me here then. Let's tie it into an EM here, which is South African Rand. Africa's front and center on a worse pandemic, and yet I noticed in South African Rand, with all of their challenges, massive, strong ZAR. Do you just assume that reverses?
Well, what's interesting is we saw a significant pullback in offshore buying of South African government bonds, which was, dominated by foreigners for a great period of time back in 2020. Now we're seeing those bond buyers return. And so that's driving up the Rand, and that's good for, the currency for now. But fundamentally, South Africa's they're a mess. Forget about the vaccines. Just talk about, Eskom and what the government needs to do to keep the country's biggest power utility operating smoothly over the next year. It's going to be a lot of money.
Damien, I've got to jump in. If they're a mess, what's dollar Rand doing south of 15?
It's coming back because there's yield there, right, Jonathan? You've got, South African bond yields significantly higher than the U.S. And so if you could just get some stability between the Rand dollar cross rate, you could pick up a heck of a lot of yield over the 10-year at 115 right now? Give me a break.
Damien, always great to catch up. Got to play pool one day. Look forward to that. Damien,
who are you betting on? I didn't get an answer. Who are you betting on for the game?
Don't get answers from our guest, Tom. Come on. Go on, Damien. Who is it?
Tampa Bay, please.
Okay, why?
Because defense wins championships, Jonathan, and they have a better defense in Kansas City, and it's really tough as a Jet fan to bet against Tom Brady.
There we go.
Does weekend open with blinding lights?
Just pretend the screen froze and the sound doesn't work anymore, Damien.
For Lisa,
Okay, ladies and gentlemen, are you looking to buy British pound? For all of you who follow my trades, it's time. The indicators and strategy tells us to place an order. So I'm placing an order to buy British pound at 136.898. Okay, where is it? 136.898. Right here. Let's wait and see. Hopefully it will get filled very quickly. Okay, I'll speak to you later.
0.5 though, Lisa Abramowitz does not get it done. We need to see something better than that.
Well, and I want to go back to the point that you were talking about. What's the market's response going to be? And I take a look. Damien mentioned junk bond yields. They're at an all-time low of 4.09%. What fundamentals are we pricing in?
I did not know that.
Are we pricing in fundamentals that have to do with the labor market, or are we pricing in the fundamentals, as you've said, John, which is monetary policy? And at what point do better fundamentals mean tighter monetary policy, which is negative for risk?
Spreads are off the tights, though. Let's be clear about that. They're off the tights.
I could make an argument, though. If you
saying.
take a look at some of the activity, it is looking like toppy markets. When you have reverse inquiries, when you have dividend payouts, when you have leverage buyouts. Just saying.
I'm just saying you could have said that at any point in the last
I think
9
it's
months.
time for a montage.
Maybe. Who of? Tom. Who of, Tom? Tom. Tom Brady.
I'm waiting for a montage here, you know.
What do you want a montage of?
I think Brady. You know, what else can you got to do a Brady montage.
Of this mess.
It works on radio.
Working perfectly this morning. From New York City this morning, good morning. Savita Subramaniam of Bank of America coming right up. This is Bloomberg.
Animals across the globe are dying by alarming rates. A report by World Wildlife Fund and the Zoological Society of London.
Well, it moved, as you can see, far to different directions. So for time being, I'm going to cancel the order to buy pound. Let's see, maybe we'll need to wait a little bit longer to enter position.
Lead to the collapse of the systems and resources that allow global civilization to persist in the first place. Overfishing and hunting, invasive species, pollution, habitat loss, and climate change are the main causes of this animal population crash. The report compiles evidence from 4,392 different vertebrate species and concludes the evidence for humanity's destruction of biodiversity is unequivocal. Using powerful computer models to simulate policy that stops biodiversity loss, scientists have explored scenarios to slow the trend. Such measures would include expanded conservation, increasing agricultural yields while also eliminating food waste, and cutting the global meat intake in half. By changing what the world eats and how it produces that food, nations could stop this tragic loss of life by almost 50%.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
vaccination and normalization strategies.
Maybe the optimism's going a little bit too fast.
The market's going to struggle at some point this year.
There are a lot of people who can't go back to work.
There is still a lot of scope for scarring in the labor market.
The virus dictated the downturn, and it will dictate the pace and the shape of the recovery as well.
It's clear that the destination for this year is COVID off.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is a most interesting jobs day. The nuance is this. Equities up, a better drift of news on the pandemic as well. We begin our simulcast with optimism as we ended yesterday. John Farrow, there's just no question, and even with the Senate vote in their late night, think 5 a.m., of an optimistic tone on this Friday.
The estimate 105, the number drops in about 29 minutes' time, Tom, and I think everyone thinks, regardless of what that number is, that stimulus package is getting pushed through down in Washington, D.C. We need to think about the implications, the consequences for this market in the months to come once we reopen. We're still shut in large part around the world. Once we reopen, what does this economy look like with this much stimulus being pushed down the pipeline and a Fed that's going to sit out for a long time?
Well, let's get right to that. I do want to say we're going to have a guest on in moments, folks. It really pushes against this wall of optimism through the last 5 days. John, you talk about the Fed and the choice that they have. I would say it's a massive assumption the Fed doesn't act forever.
Well, on the asset purchase program, they might. On rates, they've communicated pretty clearly what the threshold is, Tom.
Yeah, but when the facts change, I change.
Okay, and I think what could be interesting in the back half of this year, Tom, are the people outside the core of the Fed, outside of Powell, Clarida, outside of those two, and away to the periphery with some of the Fed presidents, which may start making some noise. And we already hear from Mr. Bostic of the Atlanta Fed, who's already talking about the potential probability, the maybe, of reducing the asset purchase program. Right. That's where the volatility might come from.
And Esther
from
George,
the bond buying,
and Esther George with our Kathleen Hayes here yesterday, I thought had a certain cautious tone. John, I want to dive into the essay of the day, which is Lawrence Summer, the former Secretary of Treasury, and yes, at Harvard as well, all of his work with Bloomberg. You know, Larry Summers, folks, writes 10 essays, and 2 of them are the Summers that we knew decades ago. This is one of them. John, what did Lawrence Summers say in the Washington Post?
Well, I think you nailed it, Tom, when you called it a clinic. I think it is a clinic. It's the compare and contrast between the stimulus package in 2009 and the stimulus package that's being rolled out now. And the compare and contrast just by looking at the output gap then, the output gap now, and the size of the package relative to that output gap. And his message is clear. This package is huge, and we need to think about how big it is, and maybe if it's too big. And Lisa asked the question earlier on this program, does it suck the air, the oxygen out of the room to do more after this, to do the infrastructure spending, the public investment that we actually need to see? Can we get that done if we push this through?
But Lisa, the other issue here to Professor Summers' comments is the application of the stimulus to the haves and the have-nots, or do we really drive it to the people in need?
Right. How do you tailor it to the people who need it the most? Ellen Zentner, I thought, was brilliant at Morgan Stanley earlier when she said that we're actually already seeing those checks that came in December get spent by families in January, that we could have even seen negative growth or a decline in the first quarter had it not been for that rescue financing. So there is a real question here, Tom. Also a real question of whether 2009 is really the template for what we want to be seeing, or whether we need and want to get it accelerating a little bit faster. But really, this is uncharted territory. That's what it just confirms, Tom.
Futures up 16, Dow futures up 126. Oil, John doesn't care about oil. I do 59.46 on Brent crude. John, one final thought before we get to Sarita. The basic idea here from Summers is we're going to get this done. It is progressive legislation. What's the risk for the banks of this legislation?
It could be really, really inflationary. I think that's the broader risk for the economy away from, say, the banks. For the banks, Tom, for this week, let's just do a quick wrap. That yield curve, yields up, curve steeper.
Yeah.
Wow, have the banks rallied over the last week. JP Morgan up more than 7%. The KBW Banks Index approaching 8-9 percentage point gains on the week so far. A lot of that is off the back of this improving bond market, at least from the bank's perspective.
And JP Morgan off the first Tuesday of November up 30+% as well. A big post-election move. Savita Subramanian watches us for Bank of America. Wonderful work in ESG and also head of equity and quantitative strategy. Savita, I love how you put the limits on where we are in enthusiasm. We're really buttressed up where you initiate sell signals. How close are we?
Yeah, so I mean, one of the ways that we gauge Wall Street sentiment is
by looking at where other strategists are in terms of bullishness. And today, the average recommended allocation to stocks that Wall Street is recommending you put into your portfolio is higher than it's been in 10 years. And it's closer to a sell signal in our work than it has been since 2007. So I think what we're seeing right now is just these levels of dangerous optimism building, especially around the S&P 500, not so much the Russell 2000, not so much Europe or emerging markets, but where we're seeing the bullishness is really concentrated in tech, in the S&P, in the NASDAQ. And I think those are signs that maybe you want to cool your heels on the S&P and look to other areas for your, real bang for your buck.
I would love to know what the conversations with clients sound like right now, Savita. Year end, 3,800 SocGen, 3,800 Citi, Bank of America, 3,800. Do you just get a lot of people turning around and saying, Savita, when are you up in the price target? What's going on over there?
Absolutely. Tremendous pressure to get more bullish. And I think the pushback that we get is, how can you be so bearish if your economists are looking for such a strong recovery in GDP? And I think the thing to point out is that the S&P is not the economy. The S&P is much more tethered to business spending rather than consumer spending. The S&P 500 is tethered to higher end spend rather than lower end spend. And I think what's really interesting right now is that investors basically want to have their cake and eat it too. So the S&P went up for many, many years amidst this really miserable economic backdrop, but it was fueled by stimulus, by low interest rates, etc. Today, we're calling for a monstrous economic recovery off of the worst recession we've ever seen, and people still think the S&P is going to be the place you want to put your money. I think that's just a false conclusion. I mean, there's got to be a change in leadership over the next 12 months if we've got a new administration in Washington, D.C., if we're moving from absolute paralysis recession to, super strong and very quick recovery. How can you continue to bet on tech, on, large cap growth amidst such what feels like really binary changes in the marketplace?
Savita, there's a difference between a change in leadership and an actual sell-off. I mean, which is it? And there's a question of what could actually be a trigger to a true sell-off versus just perhaps an underperformance of big tech versus some of these other areas.
Totally. It's a wonderful point. And this is why we're neutral on the S&P. We're not bearish. But we're saying, look, if you want to make money, there's more of a risk of downside in the S&P than upside at this point, by my lights, just based on sentiment, based on valuations, based on positioning. And I think that the idea is, we're not going to see a full-fledged bear market in the S&P 500 driven by, an economic recession. But I do think you're not going to get as much alpha from big cap tech stocks and, mega cap tech and growth than you've gotten for the last 10 years. So that's really our point. And then in terms of a sell-off, I think what's important to watch is rates and inflation. And Jonathan, you alluded to this earlier. I think what's really dangerous is we've been in a fairly benign inflationary and rates environment for many, many years. And now all of a sudden, our rates team, Mark Cabana on our rates team raised his forecast to 175 on the 10-year by year end. All of a sudden, this whole proposition of there is no alternative for income and for yield, that argument becomes more and more moot as you start to get yield in other asset classes.
So, Savita, I caught up with Mark at the end of last week about this topic, so let's just sit on it just for a final question if I can. I understand the call in the bond market. What's the call option for that to play out in the equity market? How do you want to play that through equities? If I want to tether myself to that story, that risk, which sector do I go to? Energy, financials, where do I go?
Both. And I think financials is, my number one favorite sector on this theme because it's quality of balance sheets, dividend payouts. Our banks team and Erica Najarian has been writing about how banks can essentially return a ton of capital going forward. Dividend growth, I think that's the way to play the rate story. And then energy, I think, is more of an inflationary play. And it's potentially riskier because of all the ESG work that I do, but we are overweight energy as well.
Could you tell Erica we'd like to have her on the show, Savita? Can you reach out?
Absolutely.
Can you reach out? We'd love for that to happen. Thank you. Good to see you. Savita Subramanian there. of Bank of America Securities, head of U.S. equity and quantitative strategy. Equity futures up nicely, up 15. We advanced 0.4%. That number drops in 20 minutes' time, Tom.
Yeah, it comes in 20 minutes time, and you say to yourself, what you used to say, what was the data that matters? John, I've been looking in the last 48 hours. I wonder where wage growth will be, because we don't know. We really don't know with the skew that we've seen and who has lost jobs. The 9-10 million without jobs are essentially low wage. I just wonder if wage growth is believable.
Over the last 12 months, traditional intuitive economics
hasn't
has gone
worked.
out of the window.
Hasn't worked.
Just gone out of the window. And Lisa, the prime example for me is just to look at where income has gone and look at the unemployment rate, and that correlation is just broken down.
Yeah, the idea that income has gone up because the people who have lost their jobs have been the lower income workers, so it skews the average. I think on a whole, it'll be really interesting to see how income continues to increase when we talk about inflation. I've been struck by food inflation. We really haven't talked about it, but food prices are at the highest globally in years, and chicken wings are really expensive for the Super Bowl. And it's sort of tongue-in-cheek because it's the Super Bowl, but this has a material effect on households.
Anything to get us to the Super Bowl.
Yeah, I'm just trying to bring us off the rails. It's so hard.
Bring us to the Super Bowl.
It's so difficult to get us off the rails.
Morning, Tom?
Oh,
just
come
bring
on.
us towards the Super Bowl.
You're going to blame me for that?
Every time.
John, party at Lisa's? Is this what we're hearing?
The last time it was rough,
Can you do
let me
that
tell
in
you.
New York? How does that work? What are the rules now? Can we do party at Lisa's?
We could do
Yeah, I know. How do you do the guac with a cast? I mean, folks on radio, Lisa's got this massive cast. How do you do guac with a cast?
You, your elbow.
You use your elbow. Could you not just use the other hand?
I'm not very good with my left hand.
Oh, okay. Oh, this must be tough. You're right-handed.
Yeah.
Oh, didn't know that.
Come on, John, get sensitive, John.
I didn't think.
John, boundaries.
I've got boundaries on this show.
We don't have boundaries.
I'm going through
Take us out, Tom.
withdrawals.
Take us
You
out. This
don't
is
even
beautiful.
have to do too much. You can turn me on with just a touch, baby.
Wow. You were talking about boundaries, sir. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. A 15-hour session in the Senate ended with lawmakers adopting a budget blueprint for President Biden's $1.9 trillion stimulus plan. The vote was 51-50, with Vice President Kamala Harris breaking her first tie. The House will likely vote today to adopt the Senate's language that would allow Democrats to approve the stimulus without Republican support. The House has voted to strip Georgia Republican Marjorie Taylor Greene of her 2 committee seats. That's for embracing conspiracy theories and violence against Democrats. 11 Republicans voted with the Democratic majority. Earlier, Greene said she disavowed her previous views. And the UK will require travellers from coronavirus hotspots to quarantine starting February the 15th. Arrivals from countries on the UK travel ban list will have to isolate for 10 days in government-approved accommodation. Authorities are seeking bids from hotels near airports and ports. Meanwhile, Sunday's Super Bowl in Tampa presents an experiment in coronavirus immunity. The National Football League is hoping to avoid any large-scale outbreaks at the game. Overall attendance has been capped at 25,000, a record low for football's biggest event. The league has given tickets to 7,500 vaccinated healthcare workers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Okay, I'm placing an order again for British pound at 136.895. For all of you guys, please do so if you want to trade British pound. Position open at 136.895.
The Washington Post this morning in an op-ed piece, just a clinic on what he thinks could happen, just raising some questions on the size of this package that the Democrats and this new government under President Joe Biden are trying to push through. From New York City this morning, good morning. Alongside Tom Keene and Lisa Brammitz, I'm Jonathan Ferro. We are 12 minutes away from a payrolls report in the United States of America, and we have an equity market at all-time highs. A record high coming into Friday. Futures up 15. Tom, we advance about 0.4 of 1%, and the bond market, bond yields are coming with it.
Let's get right to it, John. Let's talk to the right guest at the right time. Here's the backdrop. Lawrence Summers clearly making a tone to the progressives of economics. James Glassman was in the crucible of Northwestern economics with Robert Gordon. He's got a measured feel for the limits of the American economy. And yet J.P. Morgan is out with a huge number, 400,000-ish on jobs. That's where Glassman is, at least. Jim Glassman, you're optimistic on this report. Why?
I tell you what, we were surprised by the weakness last time. There was a lot of hospitality. These monthly numbers are very volatile.
Yep.
We don't expect anything really good until we can lift restrictions on hospitality and get kids back in schools, because that's where the problem is. So that's coming. That's in the next several months.
Jim Glass.
By the way, yes.
I want to get to the contingency plan. I know you want to talk about Lawrence Summers right now. Out there, wherever it is, why do you take issue that we do not have a contingency plan?
We have a contingency plan, and it's been visible, actually, for last year. Number one, if to the extent that the help goes to the unemployed people, it triggers off automatically when these people when we lift restrictions and they can go back to their jobs. All that money we're spending through the unemployment insurance system will trigger off. But secondly, what is it that we all buy? If we overdo the stimulus and drive consumption, a lot of what we're buying is made from overseas. And so we have all kinds of safety valves in our system that and it helps our trading partners. And by the way, this is why when you look at what happened to China last year, you wouldn't even know there was a pandemic, because China's economy grew 6.5%. And I think that tells you how connected we all are. And we don't live on an island. We live in a world economy. And if people have too much stimulus, too much money to spend, they're going to be buying things that are produced by our trading partners. And the system, the global system, needs a lot of help. So I really don't think there's much risk of overdoing this.
Wait, Jim, I want to make sure that I understand what you're saying. And to be clear, I mean, China's actual official numbers have been questioned by the likes of China Beige Book, et cetera. But there is a question that you raise implicit in your comments that any stimulus in the U.S., especially in the form of checks to families that can get spent on goods, will go to international causes, that will go to our trading partners. Do we have a sense of how much?
If we can't produce it, it goes to our trading partners, and it's a pay-it-forward story. Because if it helps our trading partners, we're all in the same soup. And if it helps our trading partners, it's going to help us also down the road.
John,
I think the system has a lot more flexibility.
John, this is so important what Dr. Glasson brings up. This is the key distinction of modern economics, John. The open versus closed economy distinction is the heart of the matter.
I know this is not where you're going, but I'll take a more literal interpretation of what you're talking about, because the sequencing of how we reopen, Jim, has shifted. And these economies could remain closed. And what I mean by that is international travel may not reopen for a long time. Jim, how are you thinking about those issues right now for the next year, the next 2 years, the next 3?
I think you'll be surprised how quickly we get this behind us once we feel like we're protecting our parents and our grandparents, because this is a medical problem. We have a medical answer now. And the minute we all feel safe, we're going to be so eager to get back to doing a lot of what we were doing. Get to the restaurant, see your friends, fly, take your family to a vacation. And by the way, if you're a business traveler, you can't manage your supply chains virtually. I've talked a lot with folks about this. It is impossible. So I think once we feel safe, you're going to be surprised how quickly we go back to that. And this air travel is going to be one. It'll take a while, but I think you're going to be surprised.
Let me put you on the spot. Let me give you a scenario. Here's the scenario. There is an English gentleman with a flight booked from JFK to Milan, Malpensa, the end of August. Does he get that flight without needing to quarantine on the other side?
If the vaccines work, if we've got this out, and we're watching it play out big time in the U.S., if the vaccines, and there's more and more vaccines coming into the pipeline, if that medical answer gets a grip on this, then I think you'll find, that he'll be able to do it without quarantining.
Dr.
This is not the new normal. Yeah, the new normal is, what does it look like when we got this nightmare behind us?
Dr. Glasson, what do we do with the 9 to 10 million that are still unemployed? I mean, what is the immediate income replacement for their rents and their landlords' mortgage payments? What do we do on that in February, not March?
Yeah, no, that's what this fiscal measure is designed to do. We did a good job of this last year. The reason there's a disconnect between unemployment and income is because that income transfer from the federal government temporarily helped people. But I think the thing to remember, the big problem, the 10 million people who are the jobs that have disappeared, a big chunk of these, by the way, are tied to the school system. 3 million jobs are related to private and public education, 4 or 5 million hospitality. So the key here is give them a lifeline until we can lift restrictions on going to the restaurant, going to the bar, going to the ball game. That's the real problem. I think the reason we're all becoming more hopeful is because we now see the third wave of the infection is fading, and we've got vaccines building. So there's a reason to be hopeful that in the next 3 to 6 months we're going to start to get our hands around this. And so we really just need a lifeline for these folks temporarily until we get there.
Jim, great to catch up, sir. As always, Jim Glassman there of JP Morgan Chase, the commercial banking head economist. We are counting you down to the payrolls report. It comes in about 5 minutes' time. Here are the estimates. 105 is the consensus estimate in our survey. The spread is wide. The highest estimate, positive 400K. The lowest, negative 250. The previous read, Tom, negative 140. We're looking for a snapback in 5 minutes.
And, John, I'm going to look what Julia Coronado is looking at, which is labor participation of that middle age group, not ancient like me. I think it's 25 to 54. I can never memorize those numbers, but I need to see a lift in that core labor participation statistic.
This market has a lift right now, so let's whip through it and get you set up. Your market higher, record highs on the S&P 500. We advance, but potentially a fifth straight day of gains, up by around about 18 points. We advance 0.5%. In the bond market, your treasury lower, yields higher. Your 10-year 117. We're up about 3 basis points. Yields are up. The curve is steeper. Equities are advancing, and the dollar is just a little bit weaker against the euro. Euro dollar 119.83, up 0.1%. The payrolls report just moments away right here on Bloomberg. The estimate 105. The print just around a corner. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From New York City, your payrolls report is seconds away, and going into that print, your equity market is at record highs. The S&P 500, positive 16 points. We advance 0.4.
I'm placing a stop on profit for British pound at 136, 900. Well, actually, I will put at 136, 9. Trying to find the resistance level for this pair. So hold on a second, I'll try to find out resistance level. Okay, stop I place in stop and profit at 136.975. Okay. I'm still holding it. Okay, let's wait and see. Yeah.
Enough. So that little tension at the bond market at the long end playing out.
Yeah, 1.1549 right now in the 10-year yield. Michael McKee, you're doing a great job. It's so much harder to do this report now than when we had the older procedure pre-Trump. Mike, I want to go to what's going to be the money question today. Obviously, the White House is going to talk up 6.3%. With what our viewers and listeners see out there, how is it possible the unemployment rate could move down to 6.3%?
Well, we did see apparently the labor force participation rate drop a little bit, and the number of people in the labor force falling back a little bit.
Is that hopelessness? Are they dropping out because it's just they've given up?
Well, they've given up in the short run. I think if you were a restaurant server, for example, you would know that in January there probably weren't going to be jobs, so you wouldn't look, but it doesn't mean you're necessarily going to be a long-term dropout from the labor force, because as COVID restrictions start to lift, you can hope that some of the restaurants start to reopen. Let me point out one thing here. I just did a little bit of math on the non-seasonally adjusted numbers. We lost 133,000 jobs in terms of non-seasonally adjusted. So the seasonals did add to the number of jobs in terms of seasonally adjusted, and takes us to just 49,000. So we did get that big gain, but we lost more jobs on a non-seasonally adjusted basis than probably anybody really anticipated.
Mike, how does this change the narrative in Washington right now?
I don't think it changes it a whole lot. I think what you're going to get is Joe Biden coming out at 11:30 today and saying this proves the need to get aid to the people who aren't working and to help the school districts so they can reopen and more of these people can get jobs. But it's kind of all the debate now moves to the Larry Summers camp, and I mean, whether you want to believe Larry or not, his op-ed today, but it's going to be how you put this together, how you target it, so that you get the most aid to the most people for the least amount of money, and politically get it passed. And that's going to be an interesting task for them to talk about in the National Economic Council and at Treasury and places like that over the next couple of days.
Michael McKee, thank you so much. Much more on this through the day. I just looked at the number, John Farrell, that I always look at, which is 27-week unemployment. And the headline for me on a number that's maybe dated and outside the pandemic, it hasn't come back. I mean, it's spiked up, not like in 2007, 8, 9, but it just won't improve. That number's still a very difficult number. John, what else do you see in the markets?
The dollar fading, euro dollar back through 120.
Oh,
so
important,
it moved through
yes.
120, up about 1/3 of 1%. And the move at the long end fading too. So yields unchanged on a 30-year, basically, on a 10-year yield, up by almost a basis point on the session. But that's faded, that move higher, since this number dropped about 6 minutes ago. But I still think, Tom, still got a couple of things to reconcile here for the long end of the yield curve. And I wouldn't make too much of a read across in the last 5 minutes or so off the back of this payrolls report. This package down in DC is massive. It's huge.
Good morning on radio and television. Right now, Jeffrey Rosenberg joining us with BlackRock, their portfolio manager of systematic multi-strategy. Jeff, how is the BlackRock call nuanced in the last 2 weeks, the cacophony of noise and what we see within this jobs report? How is the yield call morphed for BlackRock?
Well, it's really, as Jonathan was just...
I'm going to move my stop on profit for British pound at 137.015. Okay.
Of the impact, the expected impact of these very significant fiscal policies. I'll use the plural here because the focus is on the first one, the 1.8, 1.9 trillion, the fiscal plan to address COVID, but it will be followed by a second one, which is further economic fiscal interventions. And so that's really the focus here. And that's what's changing the outlook. It's steepening of the curve, increasing inflation expectations, modestly higher interest rates.
Let's talk about that a little bit more. Front end of the yield curve pinned to the floor, 10, 11 basis points on a 2-year yield. That's going nowhere for a long time unless the Fed changes course. Jeff, as you say, all the flexibility is the long end. Through the belly out to 10s, out to 30s. That's where you get this flexibility, this ability to shift higher in yields. How self-limiting do you think a sell-off could be?
Well, you know, it's about the pace of the increase in terms of it being self-limiting, right? What limits it is there a degree of increase in long-term interest rates that starts to have a meaningful impact to expectations in the real economy? Where does that mostly show up? It's through the transmission to the housing market, right? The big story in the real economy, the big beneficiary of this interest rate structure has been housing. And so if you had a significant disruption there in terms of the steepening of the curve, that's when it becomes self-limiting, because then the market starts to worry that it's gone too far, that the Fed would then ramp up its intervention. That's the first area. The second area, real quickly, is financial conditions, right? A too aggressive move in terms of the back end of the curve, steepening, taper tantrum kind of concerns that starts to disrupt financial intermediation, and the stock market, most importantly, probably triggers some kind of first verbal intervention and maybe, you know, a larger intervention if the disruption is larger. So that's the way in which it's self-limiting. This kind of gradual bear steepening that doesn't disrupt those two elements, you know, can be absorbed.
The bear steepening that we're talking about, the longer term yield going up, is it because that the supply of treasuries that the U.S. is going to be selling is going to be going up so significantly to pay for all of this fiscal stimulus? Or is it because inflation is expected to tick up with all the money circulating in the economy?
Well, it's a little bit of both. You know, the supply-demand imbalance is, or balance, I should call it, because it gets met. The question is at what price, and that's really a reflection of the total of the demand. The key is that the Fed is the major purchaser there, and so the expectations are that they'll maintain that. You know, this year, through this year, a lot of question and debate about the pace of tapering and eventually halting those purchases. But what we've seen from Fed officials recently is, no hurry to talk about and really tamping down any discussion about that. So that Fed support really helps to offset the increase in expected supply. And then the long-term inflation expectations are ticking up. We've seen that certainly in terms of break-even inflation. And that's a modest increase in a return to some term premium in the back end of the curve, but it's a very modest increase relative to historical levels.
Jeff Rosenberg, thank you so much. Greatly appreciate it. With BlackRock this morning, John, futures up 16.
Yeah, futures doing okay. This bond market moves fading though, Tom. I'm going to run. Going to get to the other studio in just a moment and catch up with Heather Boucher of the administration, Tom. So looking forward to that conversation with the Council of Economic Advisors member a little bit later this morning.
And they are in practice as they get used to the Pharaoh grilling on Jobs Day. Mohammed Al-Arian joining up there as well. Mike, I've just looked at the 27-week unemployed chart, sort of the duration chart, which is quaint. It's pre-pandemic. Do we see in the data now the truth of the American labor market? Or when everything's said and done, is it ambiguous what we see because we don't see the angst of 09, 10, 11, or maybe we don't see a better America right now?
Well, this, remember, has happened in a very short period of time. You can see the previous peak took place over a longer period of time. The number of people moving into that long-term unemployment continues to go up every month. It tells us, what the jobless claims numbers are showing us, that people who lost their jobs aren't coming back very quickly into the labor force.
Can stimulus help with that?
Stimulus can help with that, but really, to come back to what we always say, it should be tattooed on our foreheads. It's the virus that decides, because it's going to be when the companies are able to reopen and people can go back to work. We lost almost 400,000 people from the labor force this past month. And there were a lot of shutdowns. And of course, we did have some storms during the month. And so between those two things, you have people who just either couldn't get to work or didn't have a job.
Yeah.
Now, a lot of those jobs may come back when we start to open up again, and a number of states are starting to do that.
I'm struck by the unknowns here, Mike, and I was struck by what we were talking about with seasonally adjusted, non-seasonally adjusted, and how much the scenario has completely been shifted on its head because of this shift to online shopping, the shift away from brick and mortar retail. I mean, do we have a sense of how much the economy is transforming in a permanent way, and whether people are able to find jobs in other avenues to replace those that are going away?
The second thing they teach you in economics classes is that this time is different is a terrible thing to say, but it does appear that a shift is underway. Now, we all bought groceries and stuff online because we don't want to go out shopping, but will that change as we go back and the economy opens up a little more? I assume that people are going to want to go to stores and try stuff on if they can. Part of it is a social thing, being out. So I'm not sure that the degree to which we've shifted online will stay, but the convenience and the cost aspect of it is probably going to keep us moving in that direction, basically accelerating a trend already underway.
Michael McKee, thank you so much. What a nuanced and interesting jobs report as well. And the market giving us that angst, that pullback, and it's really come back nicely the last 10 minutes. Yield 1.1497, maybe not what we saw at 920, but certainly pretty good. On policy, we went out in our Rolodex and said, who is someone who did not sleep last night? That would be Henrietta Treyes of Veda Partners, looking at the festivities of the Senate and the path towards a new kind of stimulus. Henrietta, first principles, explain to our audience the distance that the Democrats are from filibuster.
Well, technically speaking, they are very far from the filibuster, but practically they are right up on it and getting closer every day as we go through what I expect will be a very generous interpretation of something called the Byrd Rule, which prohibits any policy agenda items from passing with just 51 votes. So we're very close. At about 5 o'clock this morning, the Democrats unlocked reconciliation authority, which will allow them to get their stimulus out sometime in the next just 4 weeks here, maybe 5, to provide as much as $1.9 trillion in stimulus to the U.S. economy with only Democratic votes.
Henrietta, does the senator from West Virginia apply the Byrd Rule or the marginal Byrd Rule? And can Republicans, the minority, adjust the Byrd Rule to steer reconciliation in their direction?
Well, the most important person technically here is going to be the parliamentarian, a woman named Elizabeth McDonough, and she is going to be the one who tells the Democrats how much they can get away with. In practical purposes, though, Senator Manchin is absolutely someone who is going to be able to say, maybe you can, twist the arm of the parliamentarian, but I'm still not going to vote for it. That would apply to things like getting the direct payment to individuals out to people who he thinks are in an upper income threshold, or moving the minimum wage to $15 an hour. Last night, there was a vote that got rejected, or supported rather, from the Republican side, saying, we're not going to increase the minimum wage and potentially hurt small businesses during a pandemic. And there was Democratic support for that, which points a picture of, even if Budget Committee Chairman Bernie Sanders and his Chief of Staff, Bill Downster, who is extraordinarily experienced in the reconciliation process, if Manchin's not going to vote for it, or Senator Sinema, or Warner, or Tester, or Kelly, there is nothing the Byrd Rule or tweaking the Byrd Rule can do to overcome what they will not do. So the restrictions there on policy are still very much in place by the moderates in the Democratic conference.
So basically, Biden's hope for a bipartisan Washington seemed to be fading as time goes on, rapidly fading. And there's a question of whether people's hopes for a second round of stimulus after this one, that perhaps they've gotten a little ahead of themselves, given the lack of willingness to really work together to push something through. Henrietta, do you think that it's less likely that we're going to get some sort of infrastructure spending if the Democrats push this through unilaterally?
I think it's really difficult. One of the things the street is factoring in is that Democrats are going to plow through the stimulus bill, move to an infrastructure package, and offset it with tax increases on corporations and individuals. There's just no planet where you have the votes for that. So I think the difficulty of getting another budget through, holding another all-nighter on Vote-A-Rama, and this time doing it on infrastructure spending, is going to be even more complicated than this package. So if we have 100% odds that this bill will eventually go through, whether Republicans vote in favor of another stimulus bill or not, it's going to pass. The infrastructure package is going to be even harder. And then some Democrats you talk to would say, and then we want to do a third bill after that for fiscal year 2023. And it's really hard to thread the needle for that component, especially as we get into, the 2022 midterm elections, which are just going to start around March of next year. So yeah. I think that each subsequent path forward on a partisan basis does get more difficult. But what we've seen from this president is that they're extraordinarily rigorous in their messaging. And so there's no question that we're in, COVID relief week. And right. I would be, eager to see what infrastructure week looks like under this president.
Just on a technical note, Henrietta, you were talking about taxation. And can you talk about the reconciliation process and whether Congress has to pay for some of the measures that they pass if they go through reconciliation rather than a bipartisan measure?
Great question. A major source of confusion on the street. What happened last night is the Democrats authorized $1.9 trillion in deficit increases. That is over a 10-year budget window, and that means that over 10 years, Democrats or Republicans, if they want to vote for the bill, can authorize $1.9 trillion in deficit increases, and they do not have to pay for it. Do not. There are no taxes in this bill. Indeed, there was a vote offered by a couple of Republicans that said, we will not raise taxes on small businesses during a pandemic, and it passed 100-0. So there are no taxes. This bill will not be offset by tax increases either at the corporate or individual level. The deficit spending will be incurred during that 10-year budget window, and no taxes will be increased as a result of this bill.
Well, some of the detail there, Henrietta Trey is a pro at Veda Partners there on fiscal and many conversations to come forward as well. Futures up 18, down a little bit off the shock of a difficult one-month statistic with frankly grimmer revisions as well. And then we've bounced back nicely, not up 20, but up 18. SPX Dow futures, the level 31,085. Gina Martin-Adams with us right now of Bloomberg Intelligence to review the equity market. Gina, we're halfway through earnings season. What are we going to learn next week on earnings, and is that the heart of this rally?
Yeah, I think it's been a really interesting earnings season because the first half of earnings season was really characterized by companies' remarkable beats to expectations. I mean, when we came into this earnings season, analysts were forecasting a 10% drop in EPS year. Season analysts were forecasting a 10% drop in EPS year over year for the existing constituents of the S&P 500. we're tracking a 1% decline. By the end of next week, I expect that number to be positive. So really, really strong resilience on the part of companies was the story. That translated over the course of the last week, and I expect will continue to translate over the course of the next few weeks of the tail end of earnings season into upward revision to forward forecasts. And I think that that was a key moment for the stock market, which in the early parts of the earnings season had been in a consolidation phase, certainly not rewarding beats to expectations. But over the last week, we've seen a remarkable turnaround in performance for the stock market at large, back towards cyclicals, back towards risk. And I think that's because we finally started to see analyst forecast estimates for 2021 growth improve. Even with the beats to revenues and EPS, analyst forecasts are moving up for the year ahead, which is quite remarkable considering the extent of the beat. And I think that will be what the market sort of keys on over the course of the next few weeks.
Gina, how much of that upward revision to expectations for this year's profits has already been baked into valuations?
Yeah, well, it's interesting because all of the fourth quarter beat appears to have been baked into valuations. What is not apparently expected is what's happening on 2021. And that's why we're seeing stocks move higher, is a growing confidence that analyst estimates, which are now for 24% growth in EPS in 2021, may actually be a little bit too light as companies continue to guide us toward much better than expected realities and much better than expected forward earnings growth. I think there's been a lot of chatter in the market about inflation. So we actually did go through and look at inflation mentions in company transcripts as well. And we found some interesting information there, and that is companies are even mentioning inflation risk. They're starting to mention it, but they're mentioning it at about a third as much as they did back in 2019. So what I think is going to happen over the course of 2021 is we're going to find out that analyst expectations for margins are actually quite low. They're starting to improve their expectations for revenue growth, and that's feeding through to the bottom line. What I would anticipate is if we don't get a ton of inflation pressure emerging, companies are going to produce much better than expected margin growth, which is likely going to increase that ultimate earnings growth prospect for 2021 much more than analysts had anticipated.
This is fascinating, Gina, because a lot of people talk about inflation. They talk about the potential for higher yields and that how that could eat into valuations. But you're saying on the other side of the equation, companies are seeing inflation that isn't ticking up that much. So their margins could be bigger than are currently baked in. On the first side of that equation, though, at what point do inflation expectations start to really create a trigger for valuations despite the beats, despite the increased forecasts?
Yeah, I think, frankly, we've got to see at least a tripling. Wow. Just based upon where we've been in the past and when inflation has started to creep into becoming a problem for the S&P 500. The last time we saw that was in the middle of 2018. Recall in the middle of 2018, margin forecasts peaked. As margin forecasts peaked and started to come lower, that's when the market started to enter a period of distress. So what you look for is a margin forecast peak. Just based on company transcript mentions of inflation and the rolling pace of inflation, the lack of wage inflation that we saw in the jobs report this morning, all of that in summary suggests to me that there's very limited risk to margins coming from inflation until we get to a much, much faster pace of growth.
Gina, thank you so much for the appearances today, leading our coverage of Bloomberg Intelligence on the equity markets and in the stock market. Gina Martin Adams here. Again, the level's 3883. Again, I mentioned S&P 4000 is a round number. Dow 31,090 on level. NASDAQ, are we looking at 14,000? Maybe not yet, but a nice lift to the market as well. Lisa, one of the things that has not come in is the VIX. It's like a Dean Kernick kind of question, but the VIX at 21.61 really ought to be at 19, or dare I say 17. It's not.
Well, policy uncertainty, and I would say it's not policy of the Federal Reserve, it's the policy of Washington, D.C., and how much that could affect markets. And I say to Tom, honestly, if Congress passes a $1.9 trillion stimulus, what does that do to the rates market? What does that do to inflation expectations that are already at the highest level since 2018, Tom?
Well, and again, I'd read the Summers essay as a clinic on whether you agree or disagree with Professor Summers, the idea of the dynamics that we will see forward as well. Lisa, we've got to turn to the Super Bowl. Are you going down to Tampa? I'm sorry, we've been so busy Are you going to Tampa?
You should be sorry. Yes, of course, I'm taking your private jet.
Full
You lent
team
it out
coverage.
to me. Yeah.
No, well, actually, Riley from St. Louis has a jet. She's already there. Burn stakeout last night, folks. This is news you can use. I attended Yankee spring training. Soriano was just phenomenal. You look across from Yankee spring training over to the stadium and the distance, and this is set back from the ocean in Tampa. And for those of you, I'm saying this for Pharaoh, who I know is listening. John will be there, and it's important that John understand Burn Steakhouse is the only reason to go to Tampa, and it's 4.3 distant miles away from the stadium. Leave the game early because Brady will be, Lisa Brady will have it sealed up by second half.
Oh, yeah. Well, we'll see about that. I think that it's going to be interesting to also see some normalcy come back to the world as 2021 starts to perhaps get a little bit more back to something familiar to pre-pandemic days.
We're getting there. It's been interesting. Whatever your politics, it's been an amazing 3.5 weeks off the inauguration. There'll be a reassessment. John Farrow, and speaking to the White House, Heather Boucher will join with the Council of Economic Advisors. A first look from the Biden administration for Bloomberg on this Jobs Day. Futures up 18. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
Position closed on British pound. Well done, guys. Anybody, all of you who follow my trades, we did well, right? All depends how much broker pays you per pip, yeah? You can have 5, 10, 20 pounds. In our case, we're professional traders, so we have 100 pounds per pip. It's good.
Focusing on is not so much what goes inside the cars of the future. So they're not working on doing a self-driving car or an autonomous vehicle themselves, but rather they're focusing on the surroundings. So everything that's going to go on outside the vehicle in the future. So that's sensors, cameras, radars that are embedded into roads, street signs, traffic lights, bus stops, infrastructure that's going to provide information, something to help the vehicle know what's going on around it, to help it.
Just I want to point out, it took us less than an hour to make this profit. So this is good. Anybody who doesn't have yet our strategy, you can get it. By the way, I have right now 1 hour trading course on Wednesday. So please go, you can see on the red colored sticker site, press where you can register and you can have a course together with the strategy. How we make profit, how we trade, what strategy we use, what indicators, all of these you can find for the course that will be live on Wednesday next week.
Sort of technology landscape gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes to go. Equity futures positive 15. We advance 0.4% at all-time highs on the S&P 500. We begin with the big issue, a downside surprise on the payrolls report, giving us some support to the monster stimulus effort down in Washington, D.C. Let's bring in the Bloomberg team at the markets desk, Michael McKee and Abigail Doolittle. Mike, downside surprise and some ugly revisions.
Yeah, this is kind of a wolf in sheep's clothing number. You start with unemployment. It comes in at 6.3%, and that is a big drop, 0.4% on the month. However, 400,000 people left the labor force. So that's why we saw the unemployment rate go down. Fewer people were looking for jobs. Of course, a lot of jobs, a lot of restaurants, a lot of bars, things like that closed because of COVID during the month of January. There were no jobs to go to. The other number on the headline side is the number of jobs created, which was better than maybe some people thought because we got 49,000 jobs. But we lost almost 400,000 jobs on a non-seasonally adjusted basis. And revisions, you look at the revisions, we lost another 87,000 jobs during the month of December. So 512,000 jobs lost during December. That is a terrible number, and it just makes that hole that much bigger. Normally, you would get more people coming back onto the employment rolls. The seasonally adjusted number would be higher because more people would be let go, the temporary retail workers. It did happen, but the hole was so big that we only end up with a gain of 49,000. Now, you want to look at the next numbers that you want to look at are the one bit of good news. More people getting hired at state and local levels for education, schools starting to open up, and that's been good news for the overall economy because it should help people who are on the sidelines in the labor force, particularly women, have a chance to go back to work. And that's something that is in the stimulus bill. They'll be arguing about more money for states and localities to get those schools open. We also should point out that construction jobs fell during the month. That's probably more weather related than anything else, but it's been one of the hot sectors of the economy, and we didn't gain jobs there during the month of January.
Mike, we've got to work through the bond market together as well. Let's get the board up. 2s, 10s, 30s, 2s. Pinned to the floor. There's an elephant sitting on 2s. It's called the Federal Reserve. It's going nowhere. Down the long end, here's the tug of war. Downside surprise, ugly revisions, bigger hole to climb out of. But Mike, the support for a huge fiscal effort down in D.C. And it's not just about supply. It's about what people think that supply can achieve. And that tug of war right now is taking place at the long end in the last 30 minutes, Mike.
Yeah, you're getting a reaction in the market that says, yes, these numbers were terrible, but we're looking 6 months out. And 6 months out, if we get another $1.9 trillion stimulus program, it's going to add a lot to growth. The latest forecasts are that done by the Brookings Institution and the Hamilton Project people are that we'd be 2 percentage points over the potential growth rate next year if they pass this package.
Let's keep it on the markets and cross over to Abigail. Hey, Abby.
Hi there, John. Well, the risk-on tone of this week absolutely continues. It looks like we have another case here of bad news is good news because we have stock futures higher, a little bit off the highs, but nonetheless, we are looking at the best week for the S&P 500 going back to November 6th. In fact, right now, the S&P 500 headed to its 5th up day in a row, the first time we've seen that since August. And you can see that the Russell 2000 futures really outperforming, up 0.8%. So that has everything to do with the reflation trade that has made a big return this week that we've been talking about. Yields backing up in a huge way. You and Mike just talking about that yield curve. The 10-year yield itself right now backing up for a 7th day in a row. The first time we've seen that since 2019, September of 2019. So folks are both encouraged by the fact that we have vaccine optimism, but plus that stimulus, even if it doesn't come in at $1.9 trillion, it does seem as though there's going to be money flooding the economy. Investors liking that, sending yields higher. That, of course, John, is also breaking one of the big consensus trades because in theory, rising yields should help the dollar. That's what we have going on. The Bloomberg Dollar Index right now up about 0.5% on the week, heading to its second up week in a row. Interestingly, crude higher despite that. Typically, a stronger dollar would weigh on crude oil, but that's not the case. That's the degree of the reflation tone. And where is it showing the most, John? Take a look at that KBW Bank Index on the week, up 8.8%, the best week in about 3 weeks. So reflation, reflation, reflation.
What a week for the banks it's been over the last week or so off the back of this bond market move. Let's get through the price action. Equities, all-time highs. The The dollar weaker, euro dollar back through 120. Your curve is steeper. Yields on 10s, 30s, just a little bit higher off the back of this. I have no idea if that move holds. I think there's some real tension at the back end of the yield curve that we need to resolve. Let's bring in Mohammed Al-Arian, Bloomberg Opinion columnist and Queen's College president. Mohammed, great to catch up. Your first take on a payrolls report, please.
I would call it disappointing and puzzling, given that the recent data has been better. I think, John, it points to three things. The momentum for the recovery is not established, and you see that not just from the disappointing job gains, but they were very concentrated in a few sectors, not in manufacturing, not in services. The second issue is keep an eye on labor force participation. That going down is bad news. And then the final issue I would say is, while this is good for those who want a big fiscal support, it makes the Fed's complicated policy task even more challenging.
Let's build on that, Mohammed. Do you think it's relevant for the outlook? Because some people this morning thought it wouldn't be. Do you think it is?
I think it is. I think you're going to have a very active debate. Larry Summers contributed in a meaningful manner to that debate, asking about composition and size. There are those who feel that we have to act big. This will support those who feel we have to act big. For the marketplace, John, that bad news is good news for the equity market is not new. What's really interesting, and please keep an eye on it, is that we are 4 basis points high on the 10-year and 4 basis points steeper on the 210s and 230s. That is something that's notable.
Two things to work through then. Let's get to the Larry Summers piece, and then we'll get to the bond market at the long end, Mohammed. Larry Summers raised the question that maybe this is too big. Didn't come to that conclusion, he just asked the question that relative to the output gap, relative to the size of the package that we delivered back in 2009, that this package is huge. What are the risks around it for you, Mohammed?
So if he's right, and he's picking up on 3 issues, the size relative to the output gap, the composition, is it targeted enough or not, and third, what will it do to the next fiscal package that promotes long-term growth as opposed to relief and COVID support, right? So he's raising 3 different points, and you and I have talked about this. If he is correct, with a big if, but if he is correct, it will mean that those who worry that we're pumping too much liquidity into the economy will be even more worried. John, if you do a back of the envelope calculation, you could easily get to 20 to 25% incremental liquidity injections from fiscal, monetary, and the private sectors. So it's a meaningful issue that he's raising, but one that comes at a time when I doubt the Biden administration will welcome it.
And the Fed's got no appetite to step in if everything goes right very quickly, Mohammed. They've made that very clear in the shift in their reaction function in the last 12 months. So this brings us to the bond market. How would you be pushing this through the curve, not just for the next several months? I want to understand the sequencing here. You could get that sudden rush as we re-engage with the economy, as we reopen. Then after that, the real challenge is that we haven't really changed the fundamentals. We haven't made those public investment decisions that you think, I know, we should be making. You've got the longer-term story on top. Can you just decipher between the 2 issues?
Yeah, so in a perfect world, John, and we're not living in a perfect world, but in a perfect world, as you press the fiscal accelerator more, you would take your foot off the monetary accelerator. And that rebalancing of policy would allow for a smooth transition. But as you pointed out, the Fed is in no mood to take its foot off the accelerator. In fact, when yields moved 20 basis points in the first 5 full days of trading this in January, they immediately came out with verbal intervention saying, we can do more, we can do more. So the Fed is in no mood to take off the accelerator. So the risk here is that you've got both accelerators pressed too hard, and you get more financial bubbles, and you get an inflationary scare. Now, my own view is that inflationary scare would be about a once and for all increase in prices, not an inflationary process. However, I doubt the marketplace will wait to figure that out. They'll just react. And you're starting to sense that in the bond market, putting the Fed in a difficult position.
Yields are picking up. Here's a question that would have sounded ridiculous a year ago, 9-10 months ago. Do you think this economy can handle a 30-year at 2%, a 10-year pushing 150?
The economy can, the markets cannot. And I think that's a really important distinction. There's been an enormous impact of very low yields on stock prices. In 2 ways, you and I know it. One is the TINA phenomenon. There is no alternative to stocks. Well, suddenly, if yields go up to 150, as you point out, for the 10-year, there will start being an alternative. And the second way, what discounted cash flow models are signaling. They're signaling buy, and so is the asset allocation. That's why we're seeing massive inflows still into risk markets. So it can influence the financial markets, and then the question becomes, does financial volatility harm the economy? The economy can afford it. The economy can take it. It's the financial markets that are vulnerable.
So this is my final question, Mohammed. It's a little bit provocative, so forgive me. Do you think one of the biggest downside risks to this market right now is that everything starts to go right in the economy in the next several quarters?
Yeah, I mean, you've heard me say, keep your, my four risks, and the two most likely ones, they're not baseline, they're risk factors. One is very sharp move, sudden move in yields, and the other one is some sort of liquidity accident. I have to stress, John, we came very close to a small market accident last week, very close. So we've got to keep an eye on these pockets of excessive risk-taking. And if the economy heats up and if yields move quickly, the risk of something going wrong goes up in the financial markets. Not a baseline, but certainly a risk factor worth keeping an eye on.
And you and I have got to have that conversation in the coming weeks and months. Mohammed, always appreciate your time, sir. Thank you. Mohammed Al-Erin there, the president of Queen's College, Cambridge. Counting you down to the opening bell. It's 19 minutes away with equities at all-time highs. Futures up 20. We advance 0.5%. The story, though, is in the bond market. Treasuries lower on 10s, 30s, yields higher by 4 basis points and change. More on that still to come. From the market desk with your movers, here's Abby.
John, well,
I'm placing a new order to sell short Japanese yen. The price I'm looking 105.640. Okay, 105.640. Okay, so if you are looking to sell short Japanese yen, this is the time.
So the reflation trade in full effect. Turning to earnings, Ford is getting a nice bid. They put up a surprise profit, some strength on both SUVs and trucks. They're also planning on spending on EV. And here's something you don't see every day. Ford and ExxonMobil trading higher. Another piece of that reflationary trade, of course, John, is energy and oil popping. That's the case on the week. So there's ExxonMobil. And then finally, checking in with the Reddit trade. It is back a little bit to the upside today, John. GameStop, AMC, and Express all higher. This tends to happen with these kinds of trades where you have that big surge and then down. It kind of happens in last gasp today. A little bit of to the upside.
Abby, thank you. Coming up, Fed President Esther George saying it's premature to debate scaling back the Fed's bond buying program. That conversation up next with BlackRock's Rick Reeder as we get a downside surprise on a payrolls report, an equity market at all-time highs and bond yields breaking out. More still to come from New York City this morning. Good morning. This is Bloomberg.
We have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Trading revenues coming in better than expected.
Okay, as you can see, we opened positions, so you probably opened as well. short position on Japanese yen at 105.640. Yep.
I think it is true, of course, that when you have ultra easy financing conditions for a long period of time, it can create incentives to reach for yield. It can cause some to misprice risk in markets. The real priority right now has, again, been addressing this extraordinary shock. And the Federal Reserve right now is far away from what I would say is achieving its objectives.
Kansas City Fed President Esther George defending the Fed's monetary policy, saying it's too soon to discuss tapering. Bloomberg's Sarah Ponzek joins us now for more. Hey, Sarah.
Hey, John. And she's not the only Fed official commenting on whether it's too soon or not too soon to at least start talking about tapering. Here's the current state of play. At the last Fed meeting, the Fed said that it would continue its bond buying program at the pace of $120 billion a month. That has made the Fed balance sheet swell now to about $7.4 trillion. That's up from about $4 trillion or so prior to the entire COVID fallout. But of course, a real risk this year is that growth and inflation do emerge, but faster than expected, forcing the Fed to act. After all, if you take a look at 5-year break-even inflation rates, they're at the highest since 2013. Meanwhile, 5/30 spread is at the widest, the steepest since 2015. And there you're looking at the Fed balance sheet at that $7.4 trillion level. Now, some Fed officials have discussed the idea of a taper this year, but Powell reiterated just last week that the whole focus on the exit is premature. However, at the same time, Dallas Fed President Robert Kaplan said that he expected very enthusiastic debates about the scaling back of asset purchases. But let's circle back to what we just heard from Esther George. The fact that easy monetary policy does spur this reach for yield, because today we enter the trading day with the S&P 500 at a record high, PE ratio above 30. That's higher than the dot-com days. That's looking at recorded earnings, though, not expected earnings. At the same time, though, you look at the credit market, you look at investment-grade credit spreads, they're also near the narrowest levels on record, John.
Unreal. Sarah, great to catch up. Sarah Ponzek there on this market, this bond market. Yields are higher, off the highs of the session. Quite whippy out there at the moment. We're up about 3 basis points on a 10-year, up 3 basis points or change, 2 basis points on a 30-year yield. Here's the story with the Fed's reaction function. Big shift over the last 12 months. If things get better, we won't step in and ruin the party. My words, not theirs. This is important. When this recovery starts, that reaction function becomes all the more powerful because they will not be stepping in and they'll be pushing back against those calls to do just that. On rates, the asset purchase program, things are a little bit more complex. BlackRock's Rick Reeder expecting the Feds to stay the course, at least until June. He writes the following: the Fed appears to be merely watching and promoting the efforts of the new administration and Treasury as they institute proactive fiscal support. Rick joins us now for more. Rick, first of all, on the payrolls report, sir, I would love your take, then we can move along to the bond market, please.
Sure. Thanks, Jonathan. So I'd say a couple of things. One, it was a bit softer than expected, but I think you think about what the bond market is doing and what it's done in the last few reports. The numbers have been weaker, but when you actually dig in and think about why they're softer, leisure and hospitality, no surprise, people aren't going to restaurants and the hiring can't take place there. So that is still disappointing. But when you go deeper into the report and you see things like the average work week extending, if you see things like temporary hiring growing, you see things like business services growing, what's happening is clearly you're building this dynamic where companies are trying to extend the work week a bit more. Companies are hiring temporary workers. The employment rate at the end of the year, I mean, this is something that is hugely important. We're going to get into the 4s in the unemployment rate by the end of the year. So we're going to see, and when you talk about vaccine coming in and creating herd immunity, you're going to see last month we lost over 500,000 jobs to leisure and hospitality. That'll start coming back in, and then you'll see this pretty significant jump in employment. And that's where we're going. And that's why the Fed, I think, as you get into the second quarter, the Fed's going to have to evolve the communication.
Rick, we're in such a unique moment. As you've just spelled out quite clearly, unemployment's coming down and the stimulus effort is ramping up. How powerful is that going to be? What's the best way of understanding this?
So, John, I keep going back to this one point, and I just think it's simple economics. This concept that we studied in economics, MV equals PQ. When you increase the amount of the money supply, the M, you increase the amount of liquidity in the system, you increase the monetary base. Then you put stimulus in. You are functionally creating this incredible influence on the economy. And so now, where does it come out the other side? You know, PQ, prices times quantity. I think what many people are saying, which I don't agree with, is it's going to show up in prices. And actually, I think that one of your guests on earlier was talking about this. When you look at companies and you look at their business and pricing power, I think more is going to come in quantity. So I think you're going to see growth continue to surprise people to the upside. You're seeing it in earnings today. You're going to see it, I think, going forward. And I just think, by the way, I do think inflation's moving moderately higher, but I don't think it's as scary as people would suggest. I think real growth I think we're going to hit a 7% GDP, real GDP this year.
Wow.
That's pretty powerful after where we were.
That's the analysis. What's the capital allocation decision in the Treasury market that goes along with that, Rick?
Less of those.
Yeah.
You know, John, I mean, I know we've talked about on the show the last few months. So there are, the Fed real rates haven't moved that much because what's happened is inflation has moved higher. Listen, I think we've talked about it on your show, we think the 10 years going to 1.25, but I think as you start to see the acceleration, maybe we do press a bit higher in the 10 year, maybe we do go to 150. And by the way, the one thing I will say, Mohammed has got some brilliant reads on a bunch of these things. I still don't think that that's an interest rate that is terribly devastating for companies or the economy. And I think he was right and said it didn't have much of an impact on the economy. But the one thing that I think we got to keep in mind, companies are financing still today. You're seeing financing, particularly in the front end of the yield curve, at 30, 40, 50, 60 basis points. That is incredible. So companies' ability to borrow and do M&A, do CapEx, do R&D is pretty darn powerful. I said direct injection of value into these companies. That's why the equity market will continue to appreciate that.
Rick, I'd go one step further on borrowing costs. They've termed out this debt so much. The average maturity is so much longer than it was that even if rates go up, they're not going to feel it for quite a while.
Yes, sir.
So credit versus equity right now, Rick, which one?
Oh, equity all day.
All day.
I think all day. So there is, I think high quality credit, for buying investment grade credit at 40 basis, 50 basis, or even go out the curve and it's low 1%, or even it's like not interesting. Earnings yields at 4%, free cash flow yields at 4%. That is really interesting. I know people talk about PE ratio, but gosh, these earnings numbers. I think the earnings so far, we've got 53% of the companies are reported. I think the average beat is 14%. The average revenue beat, I think 80% of the companies have reported beaten expectations on revenue, and I think higher than that on earnings. Those numbers are pretty impactful. And like you say, interest costs, their borrowing costs, which can really impact margins, are going to stay muted for a period of time.
Is there a U.S. bias to that equity allocation, Rick?
There is. Yeah, we've actually reduced some Japan. We had some because we've been believers in a cyclical dynamic. Japan's done pretty well. We've reduced some of that. But yeah, the bias is, tactically in parts of Europe, some of the banks I think are interesting. We talked about on your show for the last couple of months at price to books at such low levels. But yeah, I still think technology, cyclicals, consumer durables alongside of a good economy. I think it's hard to argue. By the way, parts of China as well in technology are also quite interesting.
Rick, looking well. Looking forward to getting you back in the studio. When can we do that?
Yes, sir.
When can we do that?
Hopefully soon.
Hopefully soon.
Sir.
Rick, fantastic to see you. Rick Reader of BlackRock on this jobs market, this economy, and this market too. What a fascinating market. The price action this week, really interesting. Equities up 19, call it 20. We advance a 0.5%. All-time highs in the equity market. Coming up, the analyst action you need to know. That'll be next in our morning calls. Then later, the Biden administration's reaction to the payrolls report. Looking forward to catching up with Heather Boucher of the Council of Economic Advisors from New York City.
You probably understood what I was doing. I am going to place stop for all of my positions that I keep open for Japanese yen. I have one position at 105.083 and two shorts position at 105.640 and 105.189. The stop going to be at 105.414 for all three positions. Okay.
We never intended it to be an action that was either illegal or caused disruption. And this was really political satire, kind of writ large, and it was all about actually trying to get to the man himself and make him see how we see him. And in order to do that, we knew it had to be big and it had to be colourful and it had to be somewhere where everybody could see it. It's important because we didn't just do this for attention. This was actually about making a serious point, which is that the majority of people in this country do reject the politics that Donald Trump represents.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Record highs in the equity market, the opening bow just around the corner. Let's get you some morning calls from the analyst community on Wall Street today. Gordon Haskett upgrading Starbucks to a buy. The analyst expecting the company to expand its market share with a number of sustainable competitive advantages. Your second call from Citi, upgrading Foot Locker to a buy, $60 price target. The analyst saying it's a good trade to play the economic recovery. And your third and final call from Goldman, upgrading Zillow to a buy with a $200 price target. The analyst citing an improving macroeconomic environment. That stock is positive by 2.6% going into the open. After the opening bell, the reaction from the White House weighing in on this morning's payrolls report. Heather Boucher of the U.S. Council of Economic Advisors just around the corner on this program live from New York. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Market that over the past few weeks has made it clear
It wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Big downside surprise on a payrolls report, an equity market that's sitting pretty at all-time highs. Up 21 on the S&P 500 on futures, we advanced 0.6%. Coming into Friday, 4 days of gains, up more than 4% on the week, heading for our biggest weekly gain since early November, and we're set to add some weight to it. A 5th day of gains on a card. That's your opening bell. Switch up the board into the bond market. That downside surprise on a payrolls report, still a lift on yields, up a basis point to about 115, but that lift fades in the last 30 minutes or so. We were up by about 4 basis points about 20 minutes ago. In the FX market, euro dollar, a break again at 120, this time to the upside, up about 0.4%. Stronger euro, weaker dollar off the back of that data an hour ago. And in the commodity market, a 57 handle on crude. We're up around 1.85% there on WTI to $57 and about 20 cents. That's the cross-asset story this Friday. And the market desk with your movers. Here's Abby.
John, it's really pretty incredible, that risk-on tone. All-time highs, as you mentioned, 5 up days in a row for the S&P 500. The first time we've seen that since August. Before going macro, let's go a little bit micro with some earnings movers, starting out with Peloton. They have an unusual problem. The stock is down because they have so much demand. They can't fulfill the bikes. They can't ship them. That's going to squeeze margins. Really pretty interesting. So that stock is down because, again, too much demand. Pinterest, not so much. They beat both top and bottom line estimates. The stock is soaring. Strong holiday season. In Activision, here is a video game maker that's selling lots of video games. The stock being rewarded, of course, those games sold online. Now, taking it macro, of course, we've been talking about that reflation trade all week. A big piece of it, of course, has to do with vaccine and the vaccine optimism. Here are lots of the vaccine makers on the move. Johnson & Johnson up 1.6%. They are seeking urgent vaccine clearance for their one-shot dose. Gilead Sciences put up a very strong quarter, helped out their 21 forecast by that remdesivir. CureVac, they have agreed to supply the UK with 50 million vaccine variant shots. And then Regeneron put up a strong quarter as well. And then finally, John, really the big story this week, banks, lots of strength here on the day. Take a look at this. We have JP Morgan, Goldman Sachs, Citigroup. Oh, there we go. Lots of green on the screen. The best week in about a month for those banks, John.
Financials flying, Abby. Appreciate it. Thank you. Much more from Abigail Doolittle through the hour. About 2 minutes into the session. Record high on the S&P, record high on the NASDAQ on the S&P. A 5th straight day of gains. Best week, biggest week of gains going all the way back to November. Record highs once again. This is the labour market. The recovery is disappointing for a second month in a row, adding fuel to the stimulus debate. I'm very pleased to say that giving us some of her time is Heather Boucher of the US Council of Economic Advisors. Heather, great to catch up with you. Thank you for your time this morning. Just help me understand, just to begin with, how the incoming data is informing the decision that you're making around fiscal stimulus and the package you're set to deliver down in DC.
Well, the numbers that we got this morning really do underscore the cost of inaction. The January numbers are quite disappointing. They show that the pace of job growth is slow. It's certainly over the past 3 months, it's a lot slower than it was earlier at the end of 2020. And it underscores that without further aid, our economy is going to continue to struggle. We need to get that aid out to the families and businesses that need it. We need to make sure that we spend the resources we need to contain the virus so that we can all get back to work. And this report really does make that quite clear.
Heather, you use that word aid, but given the size of the package, some people would just call it stimulus. It's huge. Why is that word aid different to the word stimulus? And why do you think it's aid and not stimulus?
Well, at this point in this crisis, our first goal is to contain the pandemic. So a lot of the funds that are in the American Rescue Plan are about making sure that schools can reopen, making sure that we get the vaccine out, making sure that all the things we need to do to keep Americans safe and healthy are our first priority. And while we do that, we need to make sure that businesses have the resources they need, and importantly, families have the resources they need so they can weather this crisis. So it still is, we're still really thinking about this as relief until we can contain the virus.
Larry Summers is in the Washington Post today asking some important questions about the size of this package relative to the output gap. Heather, could you weigh in on that, if at all? What the right size of the package should be relative to the output gap that we need to fill?
Certainly. You know, this package was built from the ground up. We looked at the needs all across our economy and calculated how much it was that we were going to need to spend to, again, to contain the virus, to make sure that schools could reopen, to make sure that childcare centers can reopen, to make sure that workers have paid leave, all of those sorts of things. And then to make sure that workers have those unemployment benefits as long as they need them, those direct checks for all the families that need them. So we built that in that way. And, you know, the goal here is to make sure that, you know, families and businesses can weather this crisis. And we'll worry, you know, it may be that this report from January really does show that the high unemployment, especially for communities of color, the job losses for women, and the lower labor force participation really do show that we need to continue to act, and we need to do so quickly.
Heather, what happens if everything goes right? That's the question that Larry Summers, I think, is asking. What's the contingency plan if everything starts to go right and maybe too right?
Well, you know, 2020 was a really rough year, and we know that we have a hard time predicting the shape of this pandemic. And we know that without aid, families and businesses suffer. And today's jobs report really is the proof of the proof is in the pudding here, that without continued support, we're going to see an economy that is performing much more worse than it needs to be. So I am, quite frankly, far more worried about the costs of inaction than I am of doing too much at this point.
I think that echoes what many people are talking about down in DC at the moment on both the monetary policy side and the fiscal side in this administration. Heather, let's get to one of the policies, the checks. If I earn $75,000 and I can get a big check from the US government, why is that aid and not stimulus?
Well, that is a great question. So here's the thing. You know, we saw the checks were an incredibly effective tool when they went out last spring. Families used them. They helped them, you know, when they experienced unemployment or added expenses because of the crisis. And we know that millions of families are struggling right now. And that is the purpose of topping up the checks from December to get that $2,000 out there to all the families that need them.
Talk to me about eligibility and the conversation within the administration at the moment. Heather, is there some concern that maybe the pool of people that could receive these checks is just a little bit too wide?
Well, you know, the president has been very clear that getting those checks that total $2,000 out to families is his priority, and he's been open to negotiation on the margins. But, you know, I think what's really important is that, you know, all those kindergarten teachers, those firefighters, those folks who were pulling in, you know, $60,000 or so, that they get this aid. We have seen how important it is that those checks get out there and provide those cushions for families.
They still have jobs, though, Heather. And I'm not here to advocate either side of this debate. I'm just trying to understand this just a little bit more, because the word I keep hearing down in DC is bipartisan, but this seems to be very ideological. The idea of trying to address some of the social injustices of the last several decades, maybe even longer, and not to relieve people from the effects of the pandemic. There's pandemic relief and then there's relief because of injustice or perceived injustice of the last decades, several decades in this country. Heather, which one is it?
You know, I think that this is about relief, but it is also about the fact that we are in a K-shaped recovery. You know, it continues to be the case that folks at the top end of the income distribution have done very well. Those folks that have been able to telecommute safely, you know, at the very, very top. And as you started this segment, folks, you know, who are in the stock market have seen record highs. But the reality is, for millions of families who are not in those top echelons, this has been an incredibly stressful and economically damaging time. So we need to make sure to get relief out there. You know, we need to make sure that those essential workers get that relief. We need to make sure that families who are struggling have the support they need.
Do you think it should be based on regions and the cost of living in those regions? Do you think one check for everyone, regardless of where they live, makes sense?
Well, you know, we're a big country, and certainly economic conditions are different across the country, but we are one country. And this is a federal policy to make sure that we're providing that support that we need to people all across these United States. So that seems like the right policy for this moment.
Heather, come back soon. Love to continue the conversation. Appreciate your time this morning. Thank you very much. Heather Boucher there of the US Council of Economic Advisors on this jobs report and a stimulus effort down in DC. Your equity market 9 minutes into the session, flying at 0.4%, flying on the week, maybe not on the session. Your Nasdaq up about 0.1%. Record highs here. Joining us now is JP Morgan's Anastasia Amoroso. Anastasia, thanks for your patience. Walk me through your thinking now. The policy setup, going into year end, the market setup for you.
Well, the disconnect between the market and what we're seeing in the labor market is actually pretty interesting. What Heather said is just spot on, is that the labor market that we're seeing is stagnating, and we're not seeing the job ads, we're seeing job losses. And that's because the background of the virus is still challenging, even though it's improving. I guess what I want to stress here is the market is looking through to the herd immunity, but the herd immunity, that 70% vaccination threshold, is really not until we think about September. So that does mean that we need to pave the way between what happens between now and September. We need to support the individuals in leisure and hospitality. And the reason why the market, I think, is optimistic about all of that, and especially today, is because there is a fiscal stimulus, fiscal aid that is shaping up in Washington right now that's going to help us get from here to there. Broadly speaking, when you look at the markets, it's about earnings growth. And we're just finishing up a very stellar earnings season, and we're expecting earnings to rebound by 22% this year, if not more. So just based on that, I think the market valuations are more than justified.
Within the equity market, Anastasia, where do you want exposure?
Yeah, we are looking increasingly outside of the United States, and emerging markets is one of the top ideas that's coming up to the surface here. The reason being is that we are really in the sweet spot of the business cycle where higher beta, higher growth exposures tend to outperform, and that, of course, is emerging markets. Speaking of earnings, we're expecting a rebound in global growth, especially in emerging markets, and that's going to outpace what we see in the United States, we think, by 2 percentage points. So that converts to the earnings growth pace in emerging market that's going to be above that 22% that I mentioned in the United States. So we want to participate there. The other interesting thing in emerging markets is that oftentimes we think of it as a cyclical trade, and there's certainly that cyclicality. Well, there's a twofold cyclicality. There's the commodity exposure, the higher commodity beta, but the new commodity, so to speak, for the new economy is digital. It is semiconductors, and there's increasingly that tech exposure in China, South Korea, and Taiwan. So I like that we have the combination of both of those factors. But the last thing I'll say about emerging markets, beyond the cyclical exposure that we want to have here, is a lot of the secular trends that everybody's talking about in terms of digital transformation, sustainability. This is not just a developed market story. You've got e-commerce, fintech that's taken off in Latin America at a faster clip than we see it elsewhere. And you've got sustainability that's not a European story, a US story. It's very much becoming a China story. So I just think there's a lot to do there that's right for the next 3 to 5 years, but really right for this moment in the business cycle as well.
This is the international play. Help me understand the US play right now, Anastasia. Yields are up, the curve is steeper. We've got this energy story playing out as well. Is there a preference there within the US equity market for either the financials or energy at this point?
Yeah, the preference is certainly for cyclical assets, and you've highlighted too that we definitely like financials and energy. Financial sector has been interesting to us for a number of months now, and it continues to be. As we saw the unemployment rate drop today to 6.3%, we suspect that goes to 5.5% by the end of the year, if not sooner. And if that's the case, then a lot of the banks have provisioned for a much higher unemployment rate than what we will likely have. So as we progress through the course of the year, it's not only the steeper yield curves, the higher yields, but it's the economic recovery that will lead to the loan loss reserves that was set aside. Those should be released going forward. So I think we can see a pretty significant rebound in the financial shares.
43 minutes into the program, and neither of us have mentioned a bubble. Rick Reeder didn't, Mohamed Al-Arian didn't. Can I do that now, Anastasia, if that's okay? Record highs, 38.87. I think Citi, SocGen, and Bank of America at 3,800 year end. Wells Fargo 38.50 year end. Here we are at 38.87 already. It's February 5th. I'm sure you field this question a lot when you speak to clients, Anastasia. What do you say back to them?
Look, it is the question of the day, the week, maybe the year is whether this is a bubble. But if we think about the very definitional nature of a bubble, it is something that rises over and above the fundamentals. And I think we've seen some of the stock shares that traded last week that did that. But when I look at the broad market and I see $178 on S&P earnings this year, if not more, a 21, 22 times multiple that is fair based on rates that gets us to roughly where we are today on the market valuations, and we think there's upside to that. The other big reason I would say why the conditions for the bubble to form or the bubble to burst are really missing is if you recall back in 1999, the Fed funds rate was at 6.5%. The real rate was a 4.7% rate, thereabouts. So this was an economy that was being restrained. And this is vastly different than what we have today. This is an economy with negative real rates that's being stimulated very significantly. And then when you think about, why are we having this phenomenal rally this week and year to date, is because there is just no alternative. You look at the earnings yield on equities, you compare that to the bond yield, the difference is 360 basis points, which is above the average, and it was negative back in 1999. So we just have a very different setup, and the conditions that are for the broad markets are certainly not there to call it a bubble.
Anastasia, it's been too long. Let's catch up again soon. Anastasia Amoroso there of JP Morgan. Thank you. Coming up on this program, the Senate adopting a budget blueprint for President Biden's $1.9 trillion stimulus package. That conversation up next with PGIM's Michael Collins, with an equity market sitting at record highs, a labour market that needs to see some serious improvement soon, and a bond market that's sending yields up just a little bit, and then the move fades. Your 10-year yield, 114 from New York. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We passed a budget resolution that paves the way for the passage of landmark coronavirus legislation that will save lives and livelihoods. It is a reasonable plan. It meets the needs. It is not excessive. It is coronavirus-centric. It is in a timely fashion, and that's where we have to go.
Happening any moment on Capitol Hill, President Biden meeting with Speaker Pelosi on the American Rescue Plan after Senate Democrats cleared the path for a House vote. For more, I want to bring in Kevin Cirilli down in Washington, D.C. Kevin, the Speaker of the House said it's not excessive. Some people think it is. How can you have a bipartisan effort when it doesn't look like we're getting one at all?
It doesn't look like that there's going to be any bipartisan support in terms of the $1.9 trillion stimulus package. And actually, just a couple of hours ago, after a marathon all-night Senate session, Democrats voting by a very narrow majority, the first tiebreaker vote that Vice President Kamala Harris had to cast to set up the roadmap forward for the $1.9 trillion stimulus plan. Now, where this goes in terms of a chronological timetable is likely next week. The House of Representatives will have to tweak some of their language in order to reconcile some of the differences between the House and the Senate. And then ultimately, based upon the dynamics right now, there should be passage of the economic stimulus bill sometime within the next 3 to 6 weeks. But either way, Vice President Kamala Harris really showing earlier this morning in the Senate just how crucial that tiebreaker vote is going to play for this new Congress.
Kevin, thank you. Might have a busy weekend, Kevin. Kevin's really down in Washington on a stimulus effort. Let's get to the bond market. About an hour and 20 minutes ago, this jobs report dropped. Yields faded a little bit. Then 30 minutes later, yields popped. Then they faded again. Your yield curve right now on a 10-year, a US 10-year, pretty much unchanged on the session. On a 30-year, we come in about a basis point. Keep going back to this tug of war. Got a deeper hole to climb out of. Downside surprise, really negative revisions on the payrolls report. Then on the other side, we've got a massive package to price in too. And I keep going back to a point that I think is important. For a bond market like the Treasury market, and Kit Juice of SocGen made this point on Twitter in the last hour as well, it's not just about supply. It's about what that supply can achieve. Last year, we had loads of supply. Where were Treasury yields? This year, we'll have additional supply. It's about what that supply will achieve, whether it can generate higher growth, higher inflation, all those things that would drive that curve steeper. Let's get to PGIM's Michael Collins. PGIM's Michael Collins, who I know is more constructive on this Treasury market at the long end. Mike, walk me through it. Why?
Yeah, good morning, Jonathan. You're right. Watching the tug of war this morning has really been fascinating. And I remember I was on your show almost exactly a month ago, and rates were right where they are today. They peaked at 118 on the 10-year, and we were talking about that probably being the high end or close to the high end of the range over maybe even the next few years. And I think it's really a function of what is priced in. Granted, this is a great backdrop, right? We all know that GDP is going to grow 5+% this year. Earnings are going to grow 20+%. To your point, for every trillion of stimulus, Jonathan, right? $1 trillion is about 5% of GDP. We expect that to boost actual GDP only by about 1%. That means the federal government spending is just a lousy productive use of capital, right? They have a multiplier of like 0.2, right? So there is a limit to how much this can really impact growth and really impact inflation. I think this really uber optimistic scenario may already be priced in. It may be priced into equities. It may be priced into rates. It may be priced into inflation and credit markets. I'm looking at these forward rates, Jonathan. They're gigantic. I mean, the 5-year break-even inflation rate is 2.3%. So that's already priced into the market. So unless you get that, rates should fall. The 5-year note, 5 years forward, is 1.9%. I don't think we're going to hit that, right? So the expectations are really, really probably overly optimistic.
Mohammed talked about this earlier. There's a difference between analysis on the economy and analysis for markets. For the latter, you need to start thinking about sources for upside surprise. Where does that upside surprise come from? So, Mike, I understand the approach to the Treasury market. Extend that to credit, to risk assets, to equities. Is this a sell the rumor event later this year?
You
sell
know,
the news,
it's
rather.
a time. Yeah, it's a time to start thinking about it, right? I think it's early. The way these markets tend to work, Jonathan, you get a big sell-off like you did, almost a year ago, and then you get a really big snapback. And let's talk about credit spreads, but you can relate that to equities as well. And spreads come back in really fast. And what people's tendency is to do is to fade it, right? To get out, to sell. And what they forget is the way it normally works is the following 3 or 4 years after a recession, credit spreads just continue to stay at really low levels and probably grind tighter. So that is clearly our base case. You know, you've had 90% of the upside in credit, but man, you can play and make a lot of money by getting that last 10%. So I think you're supposed to be more tactical here, to be sure, right? You're going to have more vol like you had last week. You'll have opportunities to add and cut, and that's, part of our job as active managers. But on average, you want to own credit and you want to own equities. You do not want to own treasuries and cash. You don't even want to own tips at these levels. We've been going the other way on tips, given what's priced into the market.
Mike, do you remember the good old days? You'd sit around the table with me, with Anastasia, with Rick, with Mohammed.
I miss those days.
Don't you miss it? I miss it too. When do you think we get that back? End of the year? Next
I think maybe later this year we'll be sitting together.
I cross my fingers, sir. I really do. Mike, it's good to hear from you. Hope all's well. Mike Collins there of PGIM. Thank you. Equity market, all-time high. Sector price action with Abby.
John, well, the sector action's probably a little bit more risk on than the actual gain for the S&P 500 on the day, but matching that all-time high. The S&P 500 right now up about 0.4%. Not surprisingly, that risk on tone, most of the sectors are higher. 10 of the 11 sectors are higher for the S&P 500. Only tech down slightly, and that, of course, is a defensive sector. Up top, energy, materials, consumer staples, financials somewhere in the middle. But the real story is on the week, John. So let's take a look at what's happening there, because the best sectors, energy, not surprisingly, being helped out by oil, financials being helped out by those yield curve steepening. That 530, as you know, at the steepest level since 2015. Banks like it, John.
This has been one of the more interesting weeks for price action in quite a while, I think. Some people might say it was last week with the retail side of the story, but I actually think it was this week, just trying to work out what this stimulus package will achieve, or rather what it won't achieve in some people's minds, and what it means for this bond market. And this bond market has had the keys to that outperformance in the financials that we've seen through this week that Abigail's been on top of through the week. So your equity market right now, the S&P up about 1/3%, record high. Similarly, on the NASDAQ up about 0.2%, a fifth straight day of gains in store on the S&P 500, even with, or maybe because of what happened with the labour market, delivering another downside surprise. Let's get to the trading diary, what you need to be watching the rest of today and into next week. The White House COVID-19 response team briefing public health officials at 11 a.m. Eastern. President Joe Biden speaking on the state of the economy. That will come at 11:45. Then a slew of Fed speak next week. Loretta Mester on Monday, Jim Bullard and Robert Kaplan on Tuesday. Then we'll hear from the man himself, Fed Chair Jay Powell on Wednesday. Plus we get that inflation data, US CPI data coming on Wednesday as well. Earnings continue to roll in through the week. We'll hear from Twitter, Lyft, and the Walt Disney Company as well. From New York City this morning, good morning. Thanks for choosing Bloomberg. Great to catch up with you through the week on the price action. Continue that conversation on Twitter at Fero TV. This was the countdown to the open. Enjoy the weekend, stay safe. This is Bloomberg.
Nabe, thank you so much for joining us. What was the biggest thing you've learned about what a leader needs to be?
Well, it's really an emotional, or it's about being authentic, about believing in the path you're taking.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.